Okay, good afternoon, everyone. Welcome back. Am I audible? Am I audible to you? Please do let me know. Either give me a thumbs up, say yes, whatever it is. Okay, thanks a lot. So let's start. So before the lunch break, I hope you remember we discussed monetary policy tools, qualitative, quantitative. Quantitative, either the money supply will be increased or decreased in the overall economy. Right? Such as CRR, SLR, etc. We have discussed now. Then there is a qualitative set of tools. We can use the qualitative set of tools to target specific sectors. Simple, to target specific sectors. These are called as qualitative set of tools. Now, after the quantitative and qualitative, we are supposed to start from the discussion here. How does RBI decide how much money to supply? Right? Should we increase the money supply, decrease the money supply? Should I increase repo rate by let's say 0.25%? Should I decrease the repo rate by 0.5%? How does RBI decide that? Let's start. Before the lunch break, we have discussed M0. What is M0? It is monetary base. It is let's say the high powered money, etc. Different names are there. Before the lunch break, we have discussed that. But how do you define what is M0? M0 simply represents the liability of RBI. What is the total liability of RBI? That is given in the form of M0. And I said, if M0 increases, it also means that the total amount of money in the supply or the total amount of money in circulation is expected to increase. That is M0. Now, after M0, we have M1 and M2. Another set is M3 and M4. Understand this carefully. Apart from M0, we have M1, M2, and we also have M3 and M4. Now, why I'm grouping them into two different types like this? I'll start using a technical term now. The terms are narrow money and broad money. Narrow money and broad money. Very, very famous. Remember this. Narrow money and broad money. Now you will ask me, sir, what do you mean by narrow money? What do you mean by broad money? Let me give a very simple example here. Now let's say hypothetically, I'll give you three numbers here. Just think of it and start answering. Imagine here is a person X. X has 100 rupees cash. Person X has 100 rupee cash. Then there is a bank here. Bank has, let's say, 100 rupee demand deposit, and the same bank also has, let's say, 100 rupee, right? Let's say time deposit. Time deposit. Now start answering. Start answering. If I give you three assets here, cash, demand deposit, and time deposit. Simple question. Which of the three do you think has lowest liquidity? Just think of it and answer. If I give you three assets, 100 rupee cash, 100 rupee demand deposit, 100 rupee time deposit. Which of the three has the lowest liquidity in the economy? Is it okay if I say lowest liquidity asset out of all of this is time deposit? Which has the highest liquidity? Cash has highest liquidity. Now, understand why I'm discussing lowest liquidity, highest liquidity. Now, this is point number one. Point number two. Can I say all these three, that is 100 rupee cash, 100 rupee demand deposit, 100 rupee time deposit, that is basically deposits plus cash. It is nothing but money that is there in the economy. Money that is there in the circulation. I hope you understand. Either you say 100 rupee cash is there, 100 rupee is there with a bank, 100 rupee is there in the form of demand deposit, and 100 rupee in the form of a time deposit. Can I simply say all this money is nothing but the money that is there in the system? Right? Rather than say this, can I say all of this is nothing but money in circulation? If anybody disagrees, please do let me know. Once you understand these concepts, all these are very, very easy. You should be able to understand these concepts first, right? All this, right? Sir, if we're writing only 100, can the number be different? Let's make it different. Doesn't matter. Imagine 100 rupee cash is there, 200 rupee demand deposits are there in a bank, and 300 rupee time deposits are there in a bank. Simple numbers. Can I simply say total money in the system, that is in circulation is 100 rupee plus 200 rupee plus 300 rupee, total money. But out of this 600 rupees, right, which of the or how much amount of this money has very, very low liquidity? Is it okay? Out of 600 rupee in circulation, how much out of this has very less liquidity in the economy? 300 rupees. All of you will agree? 300 rupees has very, very less liquidity. And another 300 rupees, that is the demand deposit of 200 plus 100 rupee cash deposit or cash with, let's say, the people. This has very high liquidity. This amount has very high liquidity. This has very, very low liquidity. Any difficulty in understanding this distinction? This is important. We'll start using this only now. Any difficulty in understanding the distinction here? Why I'm dividing all of this into two groups? I'm trying to find out of total money that is there in the system, that is in the circulation, how much has very high liquidity, how much has very low liquidity. And why this is important? Whenever you use the term narrow money, understand this. Simple now. Whenever you use the term narrow money, it refers to the total amount of money that is there in the circulation, but which has very high liquidity. And you need to understand it. What is the importance? I'll explain it. Have some patience. I'll repeat it again. Whenever you come across the term narrow money, what is the meaning of the term narrow money? Out of the total money that is getting circulated in the economy, how much of the money has a very high liquidity? That is called as narrow money. Any difficulty in understanding this? Any difficulty, please do let me know. And if I simply say broad money, if I use the term broad money, I'm basically trying to find out how much is the total money circulating in the system. I'm not just looking at very low liquidity, I'm also counting the money that has very low liquidity as well as very high liquidity. Now, if I ask you how much is the broad money in this example that I've given, the one with very low liquidity plus the one with very high liquidity, that will give you broad money. That should be very, very clear to you. Now, why this distinction is made? What is the reason why this distinction is made? Understand the logic here. Let me ask you a very simple question. Imagine you have 100 rupee. You have 100 rupee. Right? Answer to my question here. Why will you keep this 100 rupee in the form of cash or in the form of a demand deposit? I'll repeat it again. Imagine you have 100 rupee. You can easily go to a bank and keep a fixed deposit, by the way. I hope you understand it. You can simply go to a bank, keep a fixed deposit. But my question is, why do you use this 100 rupee, keep it either in the form of cash or in the form of a demand deposit? Why? Why do you do that? Is it okay if I say you will do this because you would require this for consumption purposes? Any day now, either it could be today, it could be tomorrow, it could be day after tomorrow, right? For immediate consumption, for immediate expenditure, you need money. Now, many of you simply say, sir, I can get the money even if I keep the amount in a fixed deposit. Agreed, you will get the 100 rupee if you keep in the fixed deposit. But simple question, you keep 100 rupee in the form of cash or in the form of a demand deposit. Can you withdraw the money at any point of time? I hope you understand. Can you withdraw the money? Can you use the money at any point of time? Somebody says no. Why? Can you take out this particular 100 rupee from the bank account even midnight? That's what I'm trying to say. Can you walk into a shop? Can you use this 100 rupee? Let's say you will use a debit card. You will use a checkbook. Right? Argument is simple. You can use the money whenever the demand arises. But on the other hand, you tell me, this 100 rupee, you will not keep it in demand deposit, nor in the form of cash. You will keep it in the form of fixed deposit. Why? And what does it indicate? You will keep it in the form of a fixed deposit because you believe that you don't require this 100 rupee for expenditure purposes. Is the logic okay? You'll say that I don't need this 100 rupee now. I might require it after 1 year. I might require it after 3 months, after 5 years, etc. You will keep this 100 rupee in a fixed deposit. Now this is important. Look at the next point here. Imagine your RBI governor. Just think of it. Imagine your RBI governor and you have gone through how much money is collected in the banks and you realize that people are keeping more and more amount of money in time deposit. What does it indicate? Just look at the application part now. Imagine you are the RBI governor. You will get the data and you look at the data and you realize that you are printing money. You are supplying money to the economy. But when that money gets circulated in the economy, people are taking that money and they are keeping this money in the form of more and more fixed deposit. Does it not indicate that the consumption expenditure is actually coming down? I hope you understand. Will it not indicate that consumption expenditure is actually coming down? People are saving more rather than spending more. Let me give you another idea. Imagine your RBI governor, you have finished lunch now, you are sitting around under AC or fan and you are the RBI governor. You are the RBI governor, you get the data and you realize that you have pumped in, let's say, 100 crore rupees into the system. You have printed 100 crore, you have issued it in the system. You realize that people are holding more and more cash and people are holding more and more amount of money in the demand deposit. And in addition to that, inflation is higher. In addition to this, inflation is higher. A simple question to you, what will you do with repo rate? Think of it and answer. What will you do with repo rate? Will you reduce the repo rate? How many of you think you will reduce the repo rate? You will increase the repo rate. Right? Some, Arey Baba, two of you are saying you will reduce the repo rate. My dear, if you reduce the repo rate, money supply increases. And I am saying already people have lot of cash. People have lot of demand deposits and inflation rate is high. If you reduce the repo rate, further you will stoke inflation in the market. Apply common sense. Start applying common sense now. And I hope you understand now. So whenever RBI will take a decision either to reduce the repo rate, increase CRR, reduce CRR, increase SLR, reduce SLR, what are the indicators they are looking at in the economy? What indicators does RBI look at? It basically looks at, okay, how much is the cash with the public? How much is the demand deposit? How much is, right, let's say, the time deposit? If I keep on printing currency, again, please understand, increasing money supply. I'll keep on saying that printing currency. But please understand this carefully. Can increase in the money supply happen in different ways? RBI will print currency and issue currency note. RBI will reduce CRR. RBI will reduce SLR. I hope you understand this. Can I say that RBI can increase the money supply in the economy by printing more currency and giving it? Money supply automatically increases. Can RBI reduce the CRR, increase money supply in the economy? I hope you understand. Will reduction in the CRR increase money supply? Answer is yes, by the way. If there is an issue, please do let me know. If RBI reduces SLR, will the money supply increase? Again, the answer is yes. So there are different ways through which RBI can increase the money supply in the economy, not just by printing money. they can reduce the CRR, reduce SLR, etc., etc., etc. Let me ask you a tricky question here. Think of this and answer. Will the reduction in the STF, right, or can the reduction in the STF increase money supply in the economy? Think of this and answer. If RBI reduces STF, will it add to higher money supply in the economy? I know, slightly tricky question, but think of it. 2 of you have already given wrong answer. 5 now. It will add to money supply. It will increase money supply. Right now, some of you ask, sir, how? Most of you answered correctly. 5 of you have basically said, no, sir, it will not increase money supply. It will increase money supply, or it may increase money supply. Think of it like this. Sir, how? How it may add to money supply? My dear, if RBI reduces STF, which means you are earning lesser rate of interest by keeping deposits with RBI, will you keep more and more deposits with RBI? I hope you understand now. If RBI reduces STF, means what? You are going to earn lesser and lesser rate of interest on it. Will you keep more and more deposits with RBI? No. Rather, you will start giving more and more loans in the market. Will it not add to the money supply? Will it not increase the money supply in the economy? Answer is yes, by the way. Any difficulty in understanding this? Right? So, this is how UPSC will trick you. All I'm trying to say is, this is how UPSC can trick you. Right? Please be very careful. Now, let me go ahead. So, all I'm trying to say is simply this. The total amount of money that is there in the circulation, we can divide into the money which has a very low liquidity and the money which has a very high liquidity. But out of the total money circulated, when you look at only the money which has high liquidity, that represents narrow money. That is called as narrow money. And if you basically count the one with low liquidity plus the one with high liquidity, that is called as broad money. Now, don't be confused with the terms narrow and broad. Simple. If I give you 3 deposits, right, or let's say if I give you cash, right, demand deposit, time deposit. When you say one with very low liquidity, is the coverage narrow? I hope you understand this. Is the coverage narrowing or not? That is the reason this is called as a narrow money. Right? And when you say, somebody says no. Narrow coverage means you're not covering all the money. You're covering limited amount of money. That is the reason it is called as a narrow money. Okay? So narrow money and broad money. M1, M2 are referred to as narrow money. M3 and M4 are referred to as broad money. What is the basic idea? Whenever the money that is getting circulated has a very high liquidity, that is called as narrow money. Low liquidity plus high liquidity, that is called as broad money. Let's start. M1, M2, right? What is covered under M1 and M2? Simple. Currency that is held by the public. Low liquidity, high liquidity or not? The currency that is there with you, me, does it have high liquidity? Answer is yes. Demand deposits that are there with the banking sector, RBI, not banking sector, RBI. Other deposits with RBI plus demand deposits with the banking sector. Low liquidity, high liquidity, hence narrow money. M1, narrow money. But in addition to M1, there is one more tool called as M2. Right? There is one more tool called as M2. It is also narrow money, by the way. Then what is the difference between M1 and M2? Please understand the historical context to this. The concept of M1, M2, M3, M4 was introduced by RBI many decades ago. Many decades ago. Now let me ask you a very simple question. If you think of the Indian economy 30 years ago, right, just go back now. You have gone, right, 30 years ago into the Indian economy. Is it okay if I say 30 years before, bank deposits were also preferred by common man? I hope you understand this. Bank deposits were also preferred by the common households, regular households. Today, the preference is very less. Or if somebody says no, my dear, it's a fact. If you say sir no, then you're wrong. It's a fact. Back in 1990s, bank deposits were also preferred by common households. Right? Why? You're talking about 1990. Again, two important points. You're talking about 1990, and second, you might be living in a city, don't apply your knowledge there. Why? In a city, every nook and corner you will find a bank. But in a village, even today, in rural parts of India, even today, availability of bank is difficult. I hope you understand my point here. In fact, that is the precise reason why Government of India says, we are trying to have one bank branch in the vicinity of 5 kilometers of every village. I hope you understand. Right, within 5 kilometers of every village, within the radius of 5 kilometers, we are trying to have one bank branch even today. Now, if Government of India says that today, I'm saying go back 3 decades ago. What could have been the situation? You can imagine. So argument is simple. Whether you agree with me or disagree, it's a fact. Remember it. Back 3 decades ago, the preference of bank deposits was very, very high. And that is the precise reason what RBI used to do was, they used to calculate one more indicator which is referred as M2. M2 basically takes whatever is the calculation of M1, currency held by the public, demand deposits in the banking sector, other deposits with RBI. Take it as it is. In addition to this, they used to add post office savings deposit. Post office savings deposit. Now please understand this. Post office savings deposit are less liquid compared to demand deposit in a bank, more liquid compared to time deposit in a bank. Is it okay? Today these are not very important, but historically I'm talking here. Post office savings deposit are less liquid compared to demand deposits, more liquid compared to time deposit. That's the reason M2 was also calculated. Now let's look at the broad money here. Broad money M3 and M4. M3, you will take M1 as it is, plus you will add time deposits in the banking sector. Time deposit in the banking sector. And M4, you will take M3 plus post office deposits. So these are the 4 indicators along with M0, totally 5 indicators which are calculated by RBI. Now many of you will ask me, sir, what is the use of it? What is the use of it? Use is very simple. Imagine M1 is very high. Imagine M1 is very high. Inflation rate is very high. You tell me what will RBI do? If you're talking about CRR, SLR and repo. Imagine M1 is very high. Inflation rate is also very high. What do you think RBI should do? Taking CRR, SLR or repo rate? Is it okay if I say, if RBI wants to control inflation, RBI should be increasing all of it? Is it okay? Let me know. Is it okay? Right, repo rate should be increased. SLR should be increased. CRR should be increased, etc. On the other hand, let's say M1 is very moderate or M1 has got stagnated. Think of this carefully. M1 has got stagnated, right? It is stable. M3 is increasing at a very fast pace. And there is a slowdown in the economy. Have a look at this. M1 has got stable. It is same. It's not changing. M3 is increasing very fast. And there is a slowdown in the economy. You tell me, if you're RBI governor, what will you do with repo rate here? What would you do with repo rate? Will you not decrease the repo rate? Will you not reduce the repo rate? I hope you understand how to read these indicators. Any difficulty? I hope you understand. I hope you understand how to read these indicators, because this is important. Every book will give you these formulas. Trust me, every book will give you these formulas. But how to use this, how to utilize it, that's very, very important for you. And in fact, understand this, in fact, there is one more indicator here. There is an indicator of money multiplier. There is something called as money multiplier. What do you mean by money multiplier? Simple. How much is the total money? I understand this. What do you mean by money multiplier? How much is the total money that gets created or added to the system, that is in the circulation, with the change in the monetary base? I will repeat it again. Right? What is this concept of a money multiplier? How much is the total money getting added to the system? To what extent the money in circulation changes with the change in the monetary base? That is called as a money multiplier. Now some of you will ask, sir, how the money circulation changes with the change in the monetary base? Let me show you a simple table here. Yesterday also we have used it. Don't by heart it. It is not necessary for UPSC. In fact, yesterday, right, I hope you remember this. We have used this table where when we are discussing the concept of the commercial bank money. Imagine RBI has printed 100 rupee and that 100 rupee has entered into the system. Simple. Imagine RBI has printed 100 rupee, that 100 rupee has entered into the system. Now, don't you think because of the fractional reserve system, money in circulation or the circulation of money will automatically increase? Is it okay? I'll repeat it again. Imagine RBI has printed 100 rupee and introduced that into the system. Don't you think because of that 100 rupee, new 100 rupee, the money in circulation increases? Right? Why? That 100 rupee will enter into a bank. Bank will use that money for circulation purposes. Give loans, give loans, give loans like this. Right? Yesterday we have discussed this. I hope you have revised it. Now, basically what RBI is trying to do is, if RBI will print, let's say 100 rupee and issue it, or RBI reduces CRR, as a result of which 100 rupee enters into the system, totally how much will be the addition to circulation? I hope you understand this. Right? Is the logic okay? If RBI reduces CRR, right, automatically money in circulation increases. And don't you think because of the fractional reserve system, credit would continuously be created by the bank because of addition of money in the system? Sir, what are you talking? Right? Very, very difficult. No. Let me take a very simple example. Right? Imagine you have, that is RBI has a reduced CRR. And as a result of this, the bank has extra 10 crore rupees to lend now. Extra 10 crore rupees. Don't you think that will increase the money supply in the economy because of fractional reserve system? Answer is yes. Can I do the same thing if I reduce SLR? If I reduce SLR, can you do the same thing? Of course, yes. If RBI prints 100 crore rupees more money and introduces that into the system, will it not increase the money supply? Of course, yes. So the argument is simple here. As the change will take place in the monetary base, as a result of this, how much will be the change in the total amount of money in circulation? That is referred to as the money multiplier. That will be referred to as money multiplier. And there are two ways to calculate this. One way that RBI calculates is M3 upon M0. Simple. One way that RBI calculates this is, right, M3 upon M0. That is, if the monetary base is changed. If the monetary base changes, imagine RBI prints 1 crore rupee cash, supplies it to economy. As a result of this, how much will be the total change in the broad money supply? How much will be the total change in the broad money supply? That measurement is called as money multiplier. And as per latest economic survey, money multiplier is somewhere around 5. I hope you understand. Money multiplier is somewhere around 5. What does it mean? If RBI prints 100 rupee and supplies it to the system, as a result of fractional reserve system, the broad money in the economy will be worth 500 rupees. Is it okay? I'll repeat it again. If the money multiplier is, let's say, 5 times, what does it mean? If the monetary base changes by 100 rupee, then the total amount of money in circulation, will change by 500 rupees. Right? And that is important. That is relevant. Why? I'll tell you. If the inflation rate is very high, if RBI reduces M0 by 100 rupee, it simply means 500 rupee will be taken out of the system. Is it okay? If RBI increases, right, the money supply by 100 rupee, then total amount of money circulation in the system will increase by 500 rupee. So in simple terms, money multiplier, right, I'll repeat it again. Money multiplier simply refers to the change in the total money circulation. And you might ask me, sir, how the money circulation will change? Don't you think because of the fractional reserve system? Again, you'll ask me, sir, what is fractional reserve system? It is the credit or the money that is created by the banks. Simple. So the money multiplier measures to what extent the money circulation in the economy will change with the change in the monetary base or high powered money. That measurement is called as money multiplier. So M3 upon M0, it is the money multiplier. Right? And one more way to find out what is the money multiplier is, for example, NCERT book will give you one more formula. They'll simply say one more way to find out money multiplier is, I'll write it, money multiplier is equal to 1 upon reserve ratio. 1 upon reserve ratio. Right? What is a reserve ratio? For example, here I've written a reserve ratio of 10%. Basically, same yesterday's calculation. I've written a reserve ratio of 10%, meaning I will write it 1 upon 10%. 10% can be written like this, 100 upon 10, cancel, money multiplier will be 10 times. Again, the argument remains same. If RBI will pump in 100 rupees into the system, because of the fractional reserve system, that maximum amount of money circulation can be 10 times of it. I'll repeat it. Right? 10 times money multiplier means what? If RBI prints 100 rupee, supplies it to the system, the change in the total money circulation can be maximum of 100 rupees. I'm sorry, 100 into 10, 1000 rupees. That is the concept of money multiplier. Okay, so M0, M1, M2, M3 and M4. These are the 5 indicators. Apart from this, there is NM0, NM1, etc. New monetary aggregates. That is not relevant for UPSC. Don't worry. Stick to these 4 more than sufficient. Now, other functions of RBI. What are the other functions of RBI? RBI is referred to as banker to the banking sector. RBI is also regulator of the banking sector. Or else you can add one more. We have discussed this in the morning. RBI, it is also referred to as Bank of Last Resort. Bank of Last Resort. Okay, Bank of Last Resort. Regarding banker to bank and Bank of Last Resort, did we discuss in the morning session? I hope you remember this. Right? The concept of the Bank of Last Resort, why RBI is referred as a Bank of Last Resort, why RBI is referred as banker to bank, we have discussed in the morning session. Why it is referred as a regulator of banking sector? Simply because whatever are the functions of a bank by the way, what a bank is supposed to do, where they are supposed to open the branches, how many branches they are supposed to open, what kind of loans they are supposed to provide, who shall be allowed to open a bank in India, which bank should be shut down. All these decisions are taken by Reserve Bank of India. Is it okay? Right? Reserve Bank of India. That's the reason RBI is referred to as regulator of the banking sector. And finally, management of the forex reserves. Management of forex reserves. right? Forex reserves basically stand for foreign exchange reserves. Foreign exchange reserves. Forex reserves, in short, stand for foreign exchange reserves. What do you mean by foreign exchange reserves? Simple. The foreign currency assets, understand this, foreign currency assets or gold or STR is maintained by Reserve Bank of India. I'll repeat it. What do you mean by Forex here? Forex basically stand for the sum total of, right, the gold, STR, foreign currency assets, and even the reserve tranche. Sum total of all of it is referred to as a Forex reserves. Who will maintain, who will manage the Forex reserves in India? It is the Reserve Bank of India, RBI. RBI maintains or manages Forex reserves in India. And if you're reading the newspaper, you should know about Forex reserves. I'll tell you the context. How many of you are reading what is happening to Pakistan? Economic wise, I'm not worried about politics, etc. How many of you are reading what is the issue in case of Pakistan? Or even before that, what was the issue with Sri Lanka? Simple, Forex reserves were depleting. The amount of Forex reserves were depleting. For example, yesterday there was a newspaper article, today also it is there by the way, not in Hindu of course, related to Forex reserves of Pakistan. The amount of Forex reserves in Pakistan have shrunk to, right, the level which are sufficient to import only for 3 weeks. I hope you understand. So Forex basically means what? It's a sum total of how much gold is there with RBI, how much STR is there with RBI, don't worry about SDR today, how much is the reserve tranche facility with RBI, that is with Government of India, and how many foreign currency assets such as a dollar, pound, bonds, etc. are there with RBI. If you take sum total of all of it, that is called as a Forex reserves. That is referred to as a Forex reserve. Done? So these are the functions of RBI, right? And again, many of you ask me, sir, what is the use of a Forex reserve? We'll discuss that as well. Not today, we'll discuss that when I take up exchange rate, balance of payment. There again, you'll come across the term Forex reserve, etc. So within this, we need to discuss STR. Can you read the statement given here? Please read the statement. Some of you are worried about it. Please read about it. There is a reserve tranche. Please read one more statement. Have patience. Even if you ask me, I'll not answer it. For that, I need concepts under IMF. So there is no way I will deviate and start answering you. Stop asking about it. If I say something I'll cover in another chapter, you can write it down, check me later. I will cover it in the later chapters. Okay, so have patience with it. What is a STR? What is a reserve tranche, etc. We'll cover it later when I take up IMF. Okay. So these are some of the very important functions of RBI. So any doubts? We have covered all the functions of RBI. Again, beyond this also, there are many other functions for UPSC. You don't have to worry. These are the most important functions. Let me know if you have any of the issues. I'll just basically put a summation of all the functions here. 1. RBI is the manager of Forex reserves. RBI is a banker to government. RBI is a banker to banks. RBI is also bank of last resort. RBI controls inflation in India. RBI is responsible for printing as well as the distribution of currencies, etc., etc., etc. And the most important one, RBI manages monetary policy. These are the functions of RBI. Any doubts? What is the difference between M0 and M1? My dear, please look at the definition or please look at the formula at least. Please look at the formula. If you don't look at the formula, you will not understand it. What is there in M0? In M0, which is a monetary base, you have currency in circulation, you have bank deposits with RBI, other deposits with RBI. Now come to M1. Do you have currency in circulation in M1? Please have a look at it. Do you have currency in circulation in M1? You will realize no. Right? Rather than that, we have, out of all the currency in circulation, we have the currency which has very high liquidity. The money which has very high liquidity, only that is covered in M1. Right? So that's the reason I told you, we basically say we basically say M1 is narrow coverage of total money in circulation, hence called as narrow money. That is the money with very high liquidity. Okay. 1 upon RR, right? 1 upon RR is nothing but reserve ratio. RR is reserve ratio. That is out of the deposits, how much percentage of the deposits the banks are not allowed to lend. That is called as a reserve ratio. As per NCERT, one more way to calculate money multiplier is, if you keep on keeping aside 20% of your deposits, or let's say 10% of your deposits, what will be the total amount of addition to money circulation if RBI prints 100 rupee? That is, if you take 10% is a reserve ratio, 1 upon 10%. 10% is nothing but 10 upon 100. Right? Use CSAT concept, 10 upon, that is, I'll have to keep on writing all of this then. 1 upon 10 upon 100 becomes, right, that is 100 upon 10. Right? Denominator of a denominator becomes a numerator. Cancel, cancel. Money multiplier is equal to 10 times. Meaning, basically, if RBI prints 100 rupee or increases the money in the circulation by 100 rupee, then the total money in circulation will change by 10 times of it. The maximum amount to what extent money in circulation can change is 100 into 10 times of it. That is 1000 rupee. That is basically called as, right, the what is that, money multiplier concept. Okay, let me start. Let me go to the next concept. DICGC. Right, and now before you start typing, sir, what is the long form of this? DICGC simply stands for Deposit Insurance and Credit Guarantee Corporation. Simple. Deposit Insurance and Credit Guarantee Corporation, DICGC. Now, it is one of the entities which comes under the ownership of RBI. RBI owns multiple entities. For example, I hope you revised it. Now you will understand it. There is one more entity which is owned by RBI, Bharatiya Reserve Bank Note Mudran Limited. Right? Did we come across this yesterday? Bharatiya Reserve Bank Note Mudran Private Limited, BRB NMPL. In fact, it was one of the functions that I discussed in the context of RBI, that is printing and distribution of currencies. Right, so apart from BRB NMPL, there are many other agencies or many other entities. One more is DICGC, Deposit Insurance and Credit Guarantee Corporation. Now, why the DICGC is relevant? What is the connection, right, of DICGC in the economy? Right, concept is very simple here. Imagine you have 100 rupee. You will go to the bank, deposit 100 rupees in the bank. Either fixed deposit, savings deposit, don't worry. You have kept the 100 rupee in the bank. Now, what if the bank incurs losses? I'll repeat. What if the bank incurs losses? Who will guarantee your money in the bank? I hope you understand. Who will provide the guarantees for your 100 rupees in the bank? That is the precise reason we have an institution by the name of Deposit Insurance and Credit Guarantee Corporation. The system is very simple here. The banks will pay certain amount of insurance premium, that is charges. The bank will pay certain amount of insurance money to DICGC, and because the DICGC is getting insurance charges or insurance premium from the bank, DICGC will provide insurance to the deposits which are there in the banking sector. Is it okay? The bank will pay insurance premium to DICGC, and in return, DICGC will provide insurance coverage to the deposits held by the banks. For example, if you keep deposits in SBI, let's say SBI incurs a huge amount of loss, which means they don't have money to pay you, then who will give you a deposit back? It is a Deposit Insurance and Credit Guarantee Corporation. Very often cited in the newspaper. The reason is very simple. Many of these cooperative banks incurred losses, and the customers who had kept the deposits in the cooperative banks lost their money. Lost in the sense, I'll come to that point, have patience. So this is the basic idea for DICGC. Now DICGC has been set up with the passage of an act, DICGC Act of 1961. It's the same DICGC. Don't ask me, sir, what is the long form of DICGC? It is already there in the first slide. So government passed an act, as a result of which an authority has been established. This authority comes under Reserve Bank of India. And this authority provides insurance coverage of 5 lakh rupees to the bank deposits. Simple. It provides insurance coverage of 5 lakh rupees to the deposits that are kept in the banks. Until very recently, this insurance coverage was 1 lakh rupees. Now it has been increased to 5 lakh rupees. Starting 2020, it has been increased to 5 lakh rupees. Meaning what? If you keep your deposits, up to 5 lakh rupees of your deposits are insured by the bank, and if the bank incurs a loss, they are unable to repay the amount to you, then it is the authority which will give you the amount back. Shall I go to the next one? And when I say insurance premium is paid by the banks, how much is the insurance premium? Until recently, the insurance premium that was paid by the banks was a 10 paise. I repeat, until recently, the insurance premium that was paid by the banks was 10 paise for every 100 rupees deposit. Recently, this has been increased to 12 paises. It has been increased to 12 paises for every 100 rupees. And next point is important. For the payment of this insurance premium, banks will not be collecting any money from the customers. I hope you understand this. Bank doesn't collect any money from the customers to provide for insurance premium for their deposits. And which all banks are covered under DICGC? Deposits with all the commercial banks and cooperative banks, except primary cooperative societies. We'll discuss regarding this after some time. Whenever you discuss cooperative segment in India, there is a segment called as Primary Agriculture Credit Society. I'll repeat the statement. Don't worry about the long form. Don't worry about the full name. We'll have a separate discussion. There is a part of cooperative which is referred to as Primary Agriculture Credit Society. These are societies by default. These are not banks. And because these are not banks, the deposits that the customers will keep with these credit societies will not be covered under insurance coverage. DICGC will not provide insurance coverage for the deposits kept under Primary Agriculture Credit Society. Right, apart from that, you can have a look at it. Public sector bank, private sector bank, foreign bank, regional rural bank, small finance bank, etc. All of them will be covered under this. Done? So this is the discussion regarding concept of DICGC. Now we are complete with RBI discussion. We are done with the complete discussion of RBI. Whatever is required for UPSC, we have covered it. Now please understand this. Sir, is this the only function of RBI? Of course no. You can read 100 hours regarding RBI. But what is relevant for UPSC, just stick to that. Please stick to that. Right? Over a period of time, certain current affairs will come in the context of RBI. Please add it. Certain concepts which are very, very new, not even covered in the books, suddenly will appear in the newspaper. Read that as well. Shall I go to the next one? Shall I go to the next one? Primary Agriculture Credit Society is the same as Primary Cooperative Society. Yes. Right? But again, please understand, when you are talking about credit society, we are looking at the banking aspect of it. Only difference is that cooperative society is a very generic term. I hope you understand this. Cooperative society is a very, very generic term. But when we are looking at those cooperative societies which are involved in giving agriculture loans, we call them as credit societies. Right? Within the cooperative society, one of the segment is credit societies. Because if you talk about cooperative societies, you can have cooperative society in housing sector. Right? I hope you understand this. Right? You can have cooperative societies in housing sector. You can have cooperative societies, let's say in jute sector. You can have cooperative societies in sugar. You can have cooperative society in milk, etc., etc., etc. But when you talk about credit, right, credit society, we are looking at only one of the components under the cooperative, that is a credit society. That's a basic understanding. Okay, next one, nationalization of the banking sector. What is the idea for nationalization? Whenever the ownership will get transferred from the private sector to the government, this is called as nationalization. Is it okay? Right? Idea is very simple. When ownership will be transferred from the government to private, privatization. Last week we have discussed this, Air India. Whenever the ownership will shift from private sector to the government, nationalization. Right? So earlier we have nationalized multiple sectors. Simple. Earlier, after independence, we nationalized multiple sectors. For example, we nationalized banking sector. We'll discuss that now. We nationalized civil aviation. Right? Civil aviation means what? Flights, right? Aeroplanes. Simple. Right? That's the reason when this idea of selling Air India to Tatas was discussed in the newspaper last year, I'm pretty sure you must have come across this. It was originally the Tatas who started Air India. I hope you understand what I'm saying. It was originally the Tatas who actually started Air India. Government of India nationalized it, which means took away the ownership, and now it has sold it back to Tatas itself. Right? So one full circle has happened there. So the argument is simple. Post independence, Government of India nationalized many sectors. Banking sector, civil aviation, or for that matter even coal mining. Coal mining was nationalized. But over a period of time, what Government of India has done is, rather than going for nationalization, we are now going for privatization. All of you will agree with me? Right? Especially in the recent times. Don't target any political party. Just stick to facts. Just stick to facts. Right? Over a period of time, especially post 1991, you will understand why. Post 1991, we have started implementing economic reforms. Economic reforms. These economic reforms are famously referred to as LPG reforms: liberalization, privatization, and globalization. Don't start typing questions on this LPG. We will have a separate discussion. Is it okay? Promise. I will discuss it separately. Industrial policy will have a detailed discussion separately. So argument is right, very simple here. Many sectors have been nationalized, but now we are going in opposite direction. We are going for privatization. Now, in that context, nationalization of the banking sector, please have a look at it. In 1970, 14 banks were nationalized. Again in 1980, 6 more banks were actually nationalized. So totally in these 2 rounds of nationalization, we have nationalized around 20 banks. Right? We have nationalized around 20 banks here. What was the reason? Why did Government of India go for nationalization at that point of time? Answer is very, very simple. Follow step by step. Now look at the time period. Please look at the time period. 1970, 1980. Don't you think this was the time period when there was a green revolution taking place in India? Right, sir? What is green revolution? Go back to our high school. In your high school, there would be pictures of a green revolution. Right? So don't you think this was the time period when the green revolution was taking place in India? Answer is yes, by the way. Second, don't you think compared to today, in 1960s, 70s, etc., the number of poor people in rural part of India was very high? I hope you understand. Number of poor people was very high. Now, when you have large population dependent on agriculture and presence of the banking sector limited to bigger cities, you are a farmer, you want to cultivate crops, you tell me from where will you take the loan from? I hope you understand. right? You're a farmer. You want to cultivate. You want to produce food grains. But the banks are limited to cities here, right? A bank is there, but let's say 20 kilometers away, 30 kilometers away. What will you do? Will you not take loan from informal sector? Is it okay? Informal simply means, again, informal credit I'm talking about. Informal loans or informal credit means when you take a loan from money lender. When you will take a loan from money lender or friend and family, generally this is called as informal credit. So don't you think when the banks are not present in the vicinity, you need a loan, you will run to the money lender, borrow from the money lender. If you don't trust me, I know some of you will never trust me, whatever I say. You're opposed to it. At least tell me, have you seen old pictures, old movies? Especially old movies which are focused on agriculture sector or rural part of India, where the hero is there in rural part of India, heroine also comes from rural part of India, villain is also a money lender. You tell me what generally you will see. Do you see a hero going to a bank to apply for a loan, or do you see the hero running to the money lender or zamindar at that point of time to borrow from them? And what do you see? When the zamindar will give the loan, the rate of interest that they charge will be very, very high. Right? If you don't know the fact, at least remember the picture, easily you can write the answer here. So the argument of the government of India was very simple. Agriculture sector, we want agriculture sector to grow fast. We want the farmers to cultivate more, sell more, earn more. But the problem was what? The banks were located in cities. And now you'll ask me, sir, why are the banks located in city? Simple question, think of it and answer. Imagine you're a private sector bank. You have an option of opening a branch in a village and also opening a branch in a city. You tell me, where will you open your branches? I hope you understand. Private sector banks, obviously they would want to earn more and more profit. Where do they say more and more profit? They will see more and more profit in cities. So the spread of the banking sector was very, very high in cities compared to rural part of India. So looking at all of these situations, multiple reforms were taken by the government. In fact, post 1975, which we'll discuss after some time, we introduced the concept of regional rural banks, RRB. I understand. Post 1975, we introduced the concept of regional rural banks. And the argument was again same. We want to promote agriculture sector. We want to promote smaller businessmen or small industries which are set up in a rural part of India, such as textile units. So the argument even at this point of time was, right, have a look at this. The banks were getting concentrated in cities. More and more loans were going to businesses. The farmers were not able to find access to cheaper loans in the rural part of India. Industries were suffering in rural part of India, etc., etc., etc. So government of India cited all of these reasons and said, let me go for nationalization of the banking sector. And the outcome is very simple. When you say nationalization of the banking sector, the banks which are privately owned now will become owned by the government. Now, do you think government will start running behind only profit? Just think of it. Right? When the ownership of the banks will go into the hands of government of India, do you think government will operate the banks only to earn profit? Answer is no. Right? The government will run these particular banks in order to earn profit, no doubt, but along with providing social welfare. Objective is to earn profit, no doubt, but that is not the only objective. It is to provide social welfare as well. If you don't agree with me, just think of railways in India. Just think of it. Railways in India. Do you think government runs and operates railways only to earn profit? How many of you think so? Does government of India run railways or operate railways only to earn profit? Answer will be wrong. Government knows that railways is one of the very, very important modes of transportation, especially for poor people. Especially for poor people. All of us use railways. For example, if you want to travel from one of the southern cities to, let's say, Delhi, or you want to travel from one part of India to another part of India, civil aviation is costly. Aeroplanes are very costly for you to travel in. One of the favorite modes of long route or long distance travel in India is railways itself. And that is a precise reason, despite incurring losses multiple times in the railways, government still operates the railways. So social welfare objective is also followed by Government of India. So this is basically the discussion about nationalization in the banking sector. But have we continued the nationalization now? Did we continue the nationalization? No. Post 1991, we have stopped nationalization in the banking sector. Is it okay? I'll repeat it again. Post 1991, we have discontinued. We have not gone for nationalization. Rather, now we are going for two very important points here. One, privatization in the banking sector. Privatization. Yet to privatize any of the public sector bank, but that's a policy. Privatization in the banking sector, right? Or before privatization, they are also trying out one more method, that is merger in the banking sector. Mergers to create bigger banks in the banking sector. Now, what is this idea of a privatization? It's very simple. Government-owned banks will be sold to private sector. Ownership will be changed to private sector. Right? Government is also trying it out, but not very successful there. But mergers, lot of the banks have been merged into other banks now. Let me give a very simple example. Earlier, there were 5 associate banks of SBI. I hope you understand. Earlier, there were 5 associate banks of SBI. For example, we had the State Bank of Patiala, State Bank of Travancore, State Bank of Bikaner and Jaipur, State Bank of Mysore, etc. Do you think even today they are present in India? No. All of these 5 associate banks of SBI have been taken, merged into one bank, SBI. Only SBI is present today. One example. Second example, earlier there was a bank by the name of Dena Bank. Right? What the Government of India has done? They have taken the Dena Bank, they have taken Vijaya Bank, merged it into one more bank, that is Bank of Baroda. Right? So what I'm trying to convey is very simple here. Government in recent times has not gone for nationalization, rather they are going for merger of these banks, so that we will create big banks in India. Is it okay? So that we will create bigger banks in India. And that is the concept of the bank mergers or idea of a big bank. Now some of you will be worried about, sir, what is the use of creating a big bank here? Why are we creating a big bank? Let me give you certain examples. Just think of it. Imagine you are developing infrastructure such as road. Right? Imagine you're developing infrastructure such as road infrastructure. A simple question to you people. Do you think developing road will require less amount of investment? I hope you understand. Do you think it will require less amount of investment? No. Investments are very, very high. High investments. Investment requirements are very, very high. And don't you think Government of India wants to promote development of infrastructure in India? I hope you understand. Sir, can you give an example? How do you say government is promoting development of infrastructure? Later, when I discuss industrial policy in India, there is one policy which has been launched by the government, National Infrastructure Pipeline, NIP, National Infrastructure Pipeline. Under National Infrastructure Pipeline, Government of India has proposed more than 9,000 infrastructure projects. More than 9,000. And the amount of investment in all these 9,000 plus infrastructure projects is more than 111 lakh crore rupees. I hope you understand the number there. More than 111 lakh crore rupees. So whenever you talk about investment, especially in development of infrastructure, requirement of investments is very, very high. Now you are that investor, you want to take a loan. Simple question, do you think all the loans in India, all the banks in India can provide you such big loans? Is it okay? Do you think all the banks in India have sufficient amount of deposits to provide big loans to you? That is bigger amount of loans. Answer is simply no. But rather than having very, very small number of banks, what if I merge these banks and I create a very big bank? Now this bigger bank, can it provide large value loans? Is it okay? Can the bigger bank, can it provide large value loans? Answer is yes, by the way. Point number one. Point number two. Imagine there are various smaller banks in India. Let's say 3 small banks. Do you think they can compete with a foreign bank, which is a very large bank, when the foreign bank will enter into India? Or for that matter, do you think these smaller banks can go to international market, start competing with foreign banks in their own countries? Some of you will ask me, sir, are Indian banks present outside India? Answer is yes, by the way. I hope you understand. Are Indian banks present outside India? Answer is yes. Many of these Indian banks are present even outside India. Just like foreign banks such as DBS. DBS is a foreign bank, right? Such as Citibank. These are foreign banks. Are they not present in India? In the same way, Indian banks are also located outside India. They're operating, they're providing services outside India. But don't you think if the size of the bank is large, it can compete even in the international market? Right? So these are some of the reasons. These are some of the reasons as to why Government of India is actually going for merger of these banks to create larger bank. So what are the advantages here? What are the benefits that you can obtain by merging these banks to create larger bank? One, cost of operations will automatically come down. Can I give an example? Let me know, most of you would have seen this. Imagine this is a city and one of the very important streets or road in a city. Now, before, let's say 10 years or let's say 10 years ago, have you not seen in a city where SBI branch is present, after a couple of shops, you will see State Bank of Patiala branch. Opposite to this, you will also see State Bank of Hyderabad branch, etc. Have you not seen this? Right? The branches of State Bank only, that is parent as well as the associated banks, these are present within a very, very small area. What is the issue with this? What is the problem if these are present? Simple. They are fighting for same customers. I hope you understand. They are fighting for same customers. Right? So rather than having multiple branches now, what if I merge, right, these two banks into only one, that is SBI? Rather than having 3 branches, can only one branch take care of all these customers? Now, if I have only one branch, right, in this particular area, tell me what will happen to cost of operations. Cost of operation means maintenance of real estate, maintenance, right, let's say providing, let's say services to customers. How many people, officers are required, right? How many vehicles are required to transport money or bring money, etc., etc. Don't you think that will lead to basically reduction in the cost of operations? That is one. Reach of the banking sector will increase. Rather than having 3 branches here, I will close 2 branches here. I will open up one more branch somewhere else. Third, the resources, human resources, right? Or let's say technological resources, real estate resources, etc., 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 can be put together. Pooled means can be put together. They can start using based on the requirement. Can lend to important sectors such as infrastructure, and they can also compete with foreign banks in India because these are bigger banks now. And on the other hand, what are the concerns then? What are the issues? If we can create a bigger bank, what are the issues? Right, have a look at this. Higher size will also mean that the impact upon the failure of such a bank will also be very high. Is it okay? I'll repeat it again. Higher the size, larger the size means the impact if this bank will fail will also be very, very high on the economy. All of you will agree with me? I'll give a very simple example. Imagine, and this is very important. Imagine you get let's say you get a news update saying that SBI is going to collapse. Again, imagine it has not happened, and let's hope it will never happen. So imagine State Bank of India is collapsing. That news update will come to you. So can you just think to what extent the whole banking sector will suffer because of it? How many infrastructure projects will suffer because of it? How many people's investment or let's say savings amount of money will be lost because of it? So that's the reason I'm saying when you merge these smaller banks into bigger banks and a bigger bank will fail, then the impact would be much, much larger. Right? Let me connect it to current affairs, and let's hope so that will not happen. And in fact, that was being discussed in multiple newspaper articles now. Can you imagine if Adani group of companies fails? Again, can you imagine? Let's hope so it doesn't happen. Can you imagine if Adani's group of companies fails now, what will be the impact on whole Indian economy? I hope you understand. Because Adani group of companies is not just present in one business. It is present in civil aviation. It is present in electric vehicles. Renewable energy. That is, they have proposed huge amount of investment in production of green hydrogen. They are present in port sector. They are present in development of roads, etc., etc., etc. So can you imagine if such a big company will fall, what will be the huge amount of impact? Again, don't start a political debate. Connect it to this, you will understand what I'm trying to say. If such a big bank will fail, then the impact will also be very, very huge. Employees are also worried about their jobs because argument is simple. If you are going to combine the company, if you're going to merge the banks into another bank, do you think they will require same number of employees? Just think of it, right? If you're going to take a bank, you're going to merge it with, let's say, SBI or any other bank, do you think they will want the same number of employees to continue? Of course, no. Many of the people will have to lose the job. Then who is going to provide the job security? Many of the people joined a public sector bank thinking that my job is secure. But now they realized, no, right, this is merged with that bank. I might be removed from a job. But again, right, there is a concern about job security. Right, what will happen if the merger happens? What will happen to work culture? I hope you understand. That's also very, very important. Right, what will happen to work culture? What will happen to working hours? What if one bank has 5 working days in a week? Another bank has 6 working days in a week. Right? Some of you will simply say, sir, bank, it will not happen. But please understand, local connection is very, very important. I hope you understand. Right? I'll give a very simple example. Earlier, Air India was 2 different companies. AI means Air India. Earlier, Air India, right, there were 2 different companies like this. One was called as Indian Airlines and the other one was referred as Air India. Now during UPA government, right, that is Manmohan Singh's government or Mr. Manmohan Singh's government, the Air India, right, the Indian Airlines was taken, merged into Air India. I hope you understand. During the earlier government, right? So the Indian Airlines was taken, merged into Air India. What was the problem with that? The work culture of both of these were completely different. I hope you understand. The work culture of both of these were completely different. Sir, what do you mean by this? In one of these companies, they had 5 working days. In another company, 6 working days. In one company, you complete 2 years, automatic promotion, guaranteed promotion. In another company, you complete 6 years of service, you are eligible for promotion. Can you see the difference in the working culture? So if such a huge difference is there in the working culture, can you imagine both of them being brought together and no problems will happen? Right? So that is the concern here. If the benefit packages are different, work cultures are different, etc., after the merger, there could be friction between these two entities. Right? So these are some of the concerns regarding the concept of big banks in India. Any doubts so far? Any issues? Any doubts so far? Can I go to the next concept? Can I go to the next concept? Let's go. Lending rate regime. Concept of lending rates. Now, before I start explaining to you what do you mean by lending rate, understand that first here. Here is a bank. Bank will collect deposits. Bank will collect deposits, let's say from customers. And bank will give loan to customers. You can use the term customers or borrowers. Now, follow the next point. When the bank will collect deposits, bank will pay interest. All of you will agree? Bank will pay interest. And when the bank will give loan, bank will collect interest. Both are different. I hope you understand this. Both are different. On one side, bank is giving. On the other hand, bank is collecting. So follow this carefully. Whatever interest bank will pay, I will call this as cost of funds. Any difficulty, let me know. Whatever interest bank will pay, because the bank has collected deposits from you. Bank has collected, right, let's say loans from RBI. Bank has collected deposits from, right, let's say companies, a fixed deposit. Now, don't you think in all these 3 cases, all the 3 cases, one, loan taken from RBI, second, a deposit taken from you, third, a deposit taken from companies. In all the 3 cases, bank will pay interest. Any doubts here? In all the 3 cases, bank will pay interest. I will call that as cost of funds. Right? What is the expenses incurred by the bank? Because they have taken the loan, they have to pay certain amount of money back. What is the cost of that? It is called as cost of funds. And second, the bank is giving a loan and will charge a rate of interest on the customer and collect it. This rate of interest that the bank will charge, I will call this as lending rate. I will refer to this as lending rate. Is it okay? When I use the term lending rate, what is it I am referring to? Is it clear to you? Please do let me know. Right, I know 3:20, time is 3:20. Some of you are sleeping. Please wake up. Right, please wake up now. Have some water. Start looking at the discussion. Right, important concepts we are discussing. So, on one side, bank is collecting deposit, borrowing money. Bank will pay interest. That will be the cost of the funds. But on the other hand, bank has basically given loans, will charge a rate of interest. I will call this as lending rate. Now the question arises, how does the bank decide this lending rate? How does the bank decide the lending rate? Now, two very important terms here. If a bank will take its own parameters, its own means they will decide whatever is the right internal situation, bank will look at its own finances and bank will decide its lending rate. That is called as internal benchmarking. Is it okay? I'll repeat it again. Bank will only decide, right? RBI will tell them, but bank itself will decide what is its lending rate. That is called as internal benchmarking. But on the other hand, what if RBI says you will have to connect your rate of interest to an external parameter? I'll repeat the statement. Right? What if RBI says you will have to connect your rate of interest to an external parameter, such as let's say repo rate? And have a look at this. This lending rate is connected to repo rate. If repo rate goes up, lending rate goes up. If repo rate goes down, lending rate goes down. Is it okay if I say that the rate of interest or the lending rate is connected to an external parameter? I'll refer to this as external benchmark. External benchmark. Any difficulty, please do let me know now. Right? One is internal benchmark. What is the meaning of internal benchmark? RBI tells them how to decide, but banks, looking at their own numbers, they will decide the lending rate. That is called as internal benchmarking. We'll discuss that. There is a tool called as MCLR. Right? We'll discuss that. Don't worry. And on the other hand, RBI says no. Right? What I'll do is, I will ask you to connect your lending rate to an external parameter such as, let's say, repo rate. Whenever the repo rate changes, you will also have to change your rate of interest. Meaning what? Now the lending rate is connected to an external parameter that is called as external benchmark. Right now, we are promoting the concept of external benchmark in India. That is, I'll tell you a simple example. If you have a housing loan, just tell me whether this is right or wrong. Some of you will say, sir, I don't have a housing loan. Please ask your parents. They will tell you that. Recently, in the last 6 to 8 months, RBI has increased the repo rate. I'll repeat it. In the last 6 to 8 months, RBI has increased the repo rate. And what has happened to the rate of interest on housing loans? The rate of interest on the housing loans also has increased. Is it okay? The rate of interest on these housing loans also has increased. If you have a housing loan, you will know it. If you don't have a housing loan, right, or let's say any kind of a loan which is connected to repo rate, please ask your parents. Ask your relatives who have taken a loan. They will start telling their own story. Right? They'll say, right, theek hai bhai, right, I know, right, you know what, in the last 3 months, RBI has increased repo rate by 50 basis points. My bank called me and said they are also increasing the rate of interest, etc., etc., etc. If you don't have anybody who has taken a loan, take it from me. A housing loan borrower, yes, it is correct. Right? In the last 6 to 8 months, RBI has kept on increasing the repo rate, and as a result of this, the rate of interest on the existing loans automatically have gone up. Right? Specifically from last year May. I hope you understand. Specifically from last year May, rate of interest have been increased. Why? Look at the inflation data. Look at inflation data. In the last calendar year means January 2022. If you look at inflation from January till October, I repeat, from January till October, inflation rate in India was more than 6%. Now you tell me, if inflation rate remains consistently above 6%, what does RBI do? RBI will increase the repo rate. I hope you understand. And if a loan that you have taken, right, is connected to repo rate, what do you think will happen to the rate of interest on such a loan? Automatically the rate of interest will also increase. Is it okay? And right, recently last week also repo rate was increased by 25 basis points. Right, going further, right, your housing loans rate of interest is going to increase. If you have not yet received the message from the bank, you will get it very soon, don't worry. Now, I'll give you a tip. I will give you a tip. Right, again, not at all relevant to UPSC, which I've told to every batch in the last 1 year. If you have a housing loan and you also have extra cash with you, try to repay the housing loan. I hope you understand. If you have a housing loan and you have extra cash with you, try to repay the housing loan as soon as possible. Why? We expect the rate of interest hikes to stop actually. I hope you understand. We expect the hike of repo rate to stop in the coming days. But there are so many uncertainties. There are absolutely so many uncertainties which might have an impact on the economy, drive up the inflation, forcing RBI to continue the hike in the rates. Right? I'll give an example. Do you know what is going to happen between Russia and Ukraine in the next 1 month? Have a look at this. Do you know what is going to happen between Russia and Ukraine in the next 1 month? If yes, please do let me know. Please do let me know. Right? Let's make huge amount of money placing bets in the market. Is it okay? Do you know whether there is going to be a recession in the global market or not in the next 3 months? Absolutely no idea. If that happens, trust me, if that happens, inflation will simply shoot through the roof. And if inflation goes up, RBI, which is expected to stop hiking the interest rate, will not have any option but to continue to increase the repo rate. Right? That is a precise reason. That is a precise reason I gave you a tip. Again, it's an advice. You want to use it, use it. Otherwise, you'll simply say, sir, you're shouting from last week only, who will listen to you? Please go ahead. Right? So this is a discussion. Now come back to this. So lending rate, right, until now, we used to decide based on internal benchmarking. Now RBI says, right, RBI says, we will shift to external benchmarking, which has already started. Housing loans are decided based on external benchmarking now. Many of these floating interest rate loans. Floating interest rate means what? Interest rates will keep on changing. It's not fixed. Interest rate will keep on changing as per the change in the economy. So floating interest rate loans are connected to external benchmark now, that is the repo rate. Most of the banks have connected their rate of interest, lending rate, to repo rate, thereby changing the rate of interest as per the change in the repo rate. Is it okay? Right? Is the logic okay? Let me know. Any example of internal benchmark? Have a look at this. There is a policy, right, from 2016. We have introduced the concept of MCLR, marginal cost of funds based lending rate. Marginal cost of funds based lending rate. Now, what is the idea of a marginal cost of funds based lending rate? Simple. Under the marginal cost of funds based lending rate, RBI told the banks, or RBI directed the banks to decide their own lending rate based on these parameters. I'll repeat it. Under the marginal cost of funds based lending rate, RBI, right, told the banks, or RBI directed the banks to decide their own lending rate based on these parameters. What are the parameters? Cost of funds. Right? Cost of funds. A bank has taken a loan from RBI. Bank has taken a deposit from customers. So whenever the cost of the funds will change, account for the change in the cost of the funds. Second, negative carry on CRR. They will use the term negative carry on the CRR, or they will also say cost of CRR. Now, what is this negative carry or the cost of the CRR? Let me explain this. Imagine you're a bank manager, right? Simple, don't get into technicalities, follow the example here. Imagine you're a bank manager, you will get 100 rupees of deposits from me. Question number 1, start answering. Are you allowed to lend all the 100 rupees that you have collected? Participate. Are you allowed to lend all the 100 rupees? Obviously no. Right? Let's say CRR is 10%. Simple numbers. CRR is 10%. Meaning what? You will take 10 rupee out of it, keep it with Reserve Bank of India. Right? You have kept 10 rupee with Reserve Bank of India. Now, simple question to you. Does RBI pay interest on 10 rupees to you? Think of it. Does RBI pay any interest on this 10 rupee to you? Answer is absolutely no. But on the other hand, will you pay interest to me on 90 rupee that you have to lend now, plus 10 rupee that you do not have the amount to lend? Is it okay? I'll repeat it. Right? I've given you 100. Imagine if CRR is 10%, means 10 rupee out of it, you'll have to keep with RBI. On this, you do not earn any interest. But when it is a question of paying interest, you will pay the interest on 90 rupee that you can lend, plus 10 rupee that you do not have the amount to lend, nor do you earn any interest on it. Now, whatever interest you pay on the 10 rupee, it is called as cost of CRR or negative carry on CRR. Any issue in understanding this? Right? Logic is simple. 10 rupee, you don't earn interest from RBI, but you pay the interest to me. Which means, right, you are not earning interest, but you are paying interest. That is nothing but cost of CRR. So when you are going to give a loan, now shift to other side. When you are going to give a loan, don't you think you should be counting what is the cost of CRR as well for you? Because you want to earn profit, you want to make money, so that you will have to pay this interest as well. So first factor, what is the cost of the funds? Second factor, negative carry on the CRR. Third factor, operational expenses. Operational expenses. Labor are there, right? Let's say you have to pay rent, you will have to pay electricity bill, internet bill. For that, don't you want to collect money? Of course, yes. And finally, right, tenor premium, that is based on the tenure of the loan, you will keep on adding more and more profit motive to that. Argument is simple. If you are giving a short-term loan, you are taking lower risk. If you are giving a long-term loan, you are taking a higher risk. Right? Don't you think when you are taking a higher risk, you should also earn more profit on it? That is the objective. Right? So whenever the banks were deciding the rate of interest, RBI said, consider these parameters and you decide. And because the banks took all these parameters and internally decided the lending rate, this is basically nothing but example of internal benchmarking. Right? Now, what has RBI done? Rather than allowing the banks to decide their rate of interest, right, based on internal parameters, rather than allowing banks to decide their own lending rate, RBI says, connect your rate of interest to an external benchmark, such as repo rate. If the repo rate goes up, your lending rate should go up. If the repo rate goes down, your lending rate should also go down. Sir, how is that possible? Simple. Let me show it to you. One of the parameters that you need to consider in the cost of funds is actually repo rate itself. All of you will agree. Cost of funds means the rate of interest that the bank will pay. And the rate of interest, one of the rate of interest that the bank will pay is nothing but repo rate. So let's say hypothetically this is the calculation. Repo rate, right, plus, right, let's say 2%. Now you'll ask me, sir, what is this 2%? Operational expenses, right? Or let's say the negative carry on the CRR, etc., etc. But please understand this, repo rate plus 2% is not actually the rate of interest that will charge on all the loans. This is generally called as a base. This is generally called as a base rate, right? What do you mean by base rate? Base rate represents the lowest rate of interest that you will charge. I hope you understand this, right? Repo rate plus 2%. What is this 2%? Negative carry on the CRR, right? Or let's say operational expenditure, etc., etc. I'll call this as a base rate. But base rate is not the rate of interest that you're going to charge to a loan. I hope you understand. Otherwise, right, now let me ask you a question, you answer it. Do you think all the loans that are issued by the bank have the same rate of interest? Just think of it and answer. Do you think all the loans that are issued by the bank carry the same rate of interest? Answer will be no, by the way. And if you ask me, sir, why do all the loans do not carry the rate of interest, same rate of interest? Answer is simple. Do you think the bank is going to take the same risk by giving the loans to different borrowers in the market? Based on the risk, don't you think the bank will have a different rate of interest for all these loans? That is what I'm trying to convey. One is a base rate. That is the lowest rate of interest that the bank will charge on the best borrower, best customer of a bank. But please understand this. What does the bank generally do? They will take this as a base, plus they will add risk premium to it. They will add risk premium to it. Right? Let me show you taking certain numbers so that you understand. Imagine the repo rate is 5%. Operational expenses, etc., etc. is 2%. So your base will be how much? 7%. Your base is 7%. Do you provide all the loans at 7%? Obviously no. You will give one loan where you feel risk is very, very low. So you might simply add a risk premium of 1%. You will charge a rate of interest of 8% on this loan. You are giving one more loan where you feel the risk that you are taking is very, very high. So you might add plus 4% risk premium. You will charge 11% rate of interest. There could be one more loan where you feel risk premium is somewhere moderate. You will add 2.5%. You will charge a rate of interest of 9.5 or 9.5%. This is how the lending rates are decided. Is it okay? This is how the lending rates are decided. Now, what is the importance of repo here? Why do we say it is externally benchmarked? Follow the next point carefully. What if I say that the repo rate is reduced from 5% to 4%? Understand this. What if I say the repo rate is reduced from 5% to 4%? Don't you think the first lending rate should automatically come down to 7%? Agreed. Follow the same calculation. The first rate of interest should come down to 7%. Second rate of interest should come down to 8.5%. Third rate of interest should automatically come down to 10%. Any difficulties here? Let me know. Any difficulties? Right? What is changing? Only the repo rate is coming down. Rest of the things will remain same. So the rate of interest or the lending rates automatically will come down. Now you tell me, what has RBI done very recently? Right? What has RBI done? Repo rate was 6.25%. It has increased it to 6.5%. Now what do you think will happen to these rates of interest? You apply the current affairs, you will get to know. Right? RBI has increased the repo rate from 6.25% to 6.5%. So if RBI increases the repo rate and these rates of interest are connected to repo rate, don't you think these lending rates should also increase? The rate of interest should also increase. That is exactly the concept of external benchmarking. And what is the idea here? Idea is simple. With the change in the repo rate, either repo rate increasing, repo rate decreasing, the lending rates should also automatically change. Is it okay? I'll repeat it again. With the change in the repo rate, the lending rates of the banks should also automatically change, whether the bank likes it or not. They will have to change the lending rate now because the repo rate has been changed by RBI. Now, simple question to you. With this system, don't you think the lending rate decision will be much more transparent? Let me know. Right, with this new system, that is the concept of external benchmarking, don't you think the calculation of lending rate will become much more transparent? Some of you are saying maybe. Why? You tell me why maybe. As a customer, that's a reason when you always take a loan or you enter into any of these financial contracts, read the documents very, very carefully. If you don't trust me, have a look at this. Right, have a look at this. If you don't trust me, at least ask your parents. They will have loan document. Whenever you take a loan from a bank, let's say housing loan, the bank will issue one document to you. And please check the document. They would clearly say how the rate of interest on the loan is calculated. Is it okay? Right, forget about me. At least your parents will have a loan, would have taken a loan, housing loan, or you would have taken a housing loan without reading these documents carefully. Open that document. Please look at it very carefully. The bank would have told you how they are going to calculate the lending rate. And they would have used repo rate here. They would simply say repo rate plus this much. That is how the lending rate is determined. So the argument is simple here. With introduction, again you might disagree, but write this in the exam. Write this in the exam. This is correct, by the way. With the introduction of external benchmarking, the calculation of lending rate is expected to become much more transparent, point one. And second, the transmission of the monetary policy will also be much more effective. I'll explain that. Second point, the transmission of monetary policy will also become much more effective. And third very important point, the lending rates are fair to both the lender as well as borrower. I'll repeat the third point. The lending rates are fair for both the lender as well as the borrower. Now, second point, what do you mean by monetary policy transmission? What do you mean by monetary policy transmission? Let me give you a very simple example. Imagine here is RBI. RBI will give loan to a bank. Bank will give loan to customer. Now start. If RBI reduces the lending rate, what do you expect the bank to do? I hope you understand. If RBI reduces the lending rate, what do you expect the bank to do? It will also reduce its lending rate, and as a result of this, the lending rate in the market should come down. The loans issued in the market should increase. Agreed or disagreed? Please do let me know. Right? RBI has reduced its lending rate. Bank should also reduce its lending rate and increase the number of loans or the value of loans that they are issuing. Now, this is called as transmission. Is it okay? This is referred to as transmission of the monetary policy. Transmission simply refers to what? To what extent the lending rate has changed. How much value of the loans has been increased, etc., etc., etc. That is called as a monetary policy transmission. Now, is it okay if I say with external benchmarking, there will be efficient monetary policy transmission? Just look at the statement. Right? I'll repeat the statement, by the way. With external benchmarking, there will be much better efficient monetary policy transmission. That is, if RBI reduces the repo rate, now the banks do not have any option because their lending rates are connected to, let's say, repo rate. They will also have to reduce their lending rate. If RBI increases the repo rate, the banks don't have any option. They will also have to increase their lending rate. Don't you think this is a much better monetary policy transmission? Right, so that is a second very important advantage associated with external benchmarking. So MCLR, internal benchmarking, RBI gave the parameters, banks decided their lending rate. The external benchmarking, RBI says, please connect your lending rate to repo rate. Connect your lending rate to, right, let's say yield rate on government bonds, etc., like this. So whenever these parameters, external parameters will change, automatically the lending rates will also change. Right? This concept was proposed or was recommended by a committee, Janak Raj Committee. Remember the name of the committee. The concept was proposed by a committee by the name of Janak Raj. Mr. Janak Raj headed it, and RBI has actually introduced it. Right, today the floating interest rate floating interest rate loans follow the concept of external benchmarking. Okay, done. So this is the basic idea of the lending rate regime. Let me go to the next one. But before that, but bank not fully 100% borrow from RBI. Then how bank manage its profit and loss? They will manage their profit and loss by basically considering, if you remember, that 2%, within that 2%, they are considering operational expenses. There is a risk premium also, right? The profit and loss is accounted there itself. Again, it's not more of a loss, but they will account for their profit motive. Okay. Suppose I had taken loan at 5% rate of interest, and if the repo increases, it means I have to pay more on the same loan. Yes. Rate of interest will change. Loan value doesn't change. Rate of interest changes. Okay. Difference between M0 and M3. M0 is a high powered money, monetary base. That is basically how much money has been printed by RBI and issued. Now, because of circulation in the economy, M3 represents, as a result of fractional reserve system, how much is the total money in the circulation. Right? That is M3. Okay. Next, basic concepts to understand the idea of a Basel. Before that, let's take a break. Okay, before that, let's take a break. Again, sir, this kind of a loan, is it associated? That kind of a loan, is it associated? Right? Please, if you have taken a loan from a bank, you check it. I don't know which bank is connecting which loan to that. If it is a floating rate of interest loan, I know that they will generally connect it to external benchmarking. Now you check with the respective bank that you have taken a loan from, whether they have connected this, whether you have opted for this or not. Right? I don't run a bank, so I don't know. Right? So you check it with the respective banks. Okay, done. So next is the basic concept to understand Basel. But before that, let's take a short break. Let's take a short break. Okay, I'll restart at 3:53. I'll restart the session at 3:53 p.m. by the way, not a.m. 3:53 p.m. Okay, take a break now. Take a break. Okay. Welcome back. Am I audible? Am I audible? Can I start? Sir, you are late by 1 minute. My dear, by the time I gave the break, right, some of you are commenting, sir, only 3 minute break, only 4 minute break. That's the reason I said, okay, let me extend by 1 more minute. Okay, now again, this is my sincere advice to all of you. Sincere advice. Some of you, I generally see that you are worried about break. I do understand the sessions are lengthy, it's slightly difficult for you, etc., etc. But my advice to you people would be, get used to it. You may disagree with me, right? That's your right, by the way. Okay, you may disagree. But let me tell you, let me take a 30-second break now and tell you why it is actually required. One, UPSC requires a lot of dedication. Lot of dedication. Dedication requires a lot of attention. I hope you understand my point. And second, think of the long term. Think always of the long term. Right? Let's say you're writing UPSC mains examination. I don't know how many of you know this. Every day when you write UPSC examination, there are two papers. Mains examination, prelims anyways, 2 papers, 2 hours each. Mains, every day, there are 2 papers each every day. 3 hours, 3 hours, 3 hours, 3 hours, 3 hours, 3 hours. So the amount of the pressure that you people will face during those, let's say, 10 days will be unimaginable. Right? How do you basically get used to it? Learn to thrive under pressure. Simple. Learn to thrive. Thrive means enjoy pressure. Right? When you get used to the pressure, it's like, okay, you're sitting for 10 hours. No problem. I'll sit. You're getting a break after 3 hours. No problem. I'll sit for 3 hours. When you start to enjoy, thrive under pressure, trust me, sitting for longer durations will never be a problem. Facing two papers every day will never be a problem, provided you have studied for it. Don't imagine that only sitting for longer duration you will get through UPSC. No, that is one part of it. Right? Studying is also, right, equally important, or should I say more important than sitting. Anyways, right, so left to you, you decide what you want to do. What I would recommend is get used to it. Let's start now. Now, basic concept to understand Basel guidelines, right? Idea of a Basel guidelines. Now, follow this very carefully. First and foremost, what do you mean by Basel? Some of you will start saying, sir, please give me the expansion. Give me the long form of Basel guidelines. Basel is not an acronym. It's not a short form. Basel is a name of a city. Simple. Basel is a name of a city. Now, in this Basel city, there is a grouping, or there is an institution by the name of Bank of International Settlement. I'll come back to this slide, don't worry. At this particular place of Basel, there is one institution, there is one authority by the name of Bank of International Settlement. Now, should you read BIS for UPSC? Absolutely no. BIS, India is a member of it. India is a member of Bank of International Settlement, and within this Bank of International Settlement, there is a committee by the name of Basel Committee on Banking Supervision. There is a committee by the name of Basel Committee on Banking Supervision. Right? So this is this committee. Right? It is this committee which will keep on giving guidelines which should be followed by member countries under Basel. Is it okay? Right? There is a place called as Basel in Switzerland, and in that place there is one institution, Bank of International Settlement. India is a member of it, and within this Bank of International Settlement there is one committee, name is Basel Committee on Banking Supervision, and it is this committee which will give recommendations, which are supposed to be followed by the banks. Right? For example, India, RBI is a member to this. So this committee, when it has given recommendations, RBI will implement the recommendations. Now, what are the recommendations? We'll understand that But to understand these recommendations, first you need to understand certain basic concepts. And these are very much relevant. We'll connect it to current affairs. Understand this carefully. Now, first, what is the capital of the bank? Right? Capital basically refers to the money that is there or the total assets which are held by the bank. Now, generally the assets or the money that is held by the bank is divided into two parts. Tier 1 capital and Tier 2 capital. Tier 1 capital is called as a core capital. Tier 2 is referred to as supplementary capital. We'll connect it to current affairs, by the way. Right? I'll connect it, just have some patience. Now, some of you will ask me, sir, tell me what is the meaning of capital in the first place? Let's take a very simple example. You want to start a company. Is it okay? You want to start a company. Will you have money to spend and set up a company or not? You will have money which you will use to set up a company. That is nothing but capital. I hope you understand that money you will use to set up a manufacturing facility, to purchase a machine, that is called as capital. Right? So have a look at this. For banking sector, under Basel, there is a requirement to calculate what is the capital of a bank. Why it is required to calculate capital of a bank? Let me ask you a very simple question. Imagine, right? Imagine here is a bank. You are the manager of the bank. You have collected deposits from the customers. If the bank is incurring a loss, what will you do? Right? When you close up, that's a different issue altogether. But there will be certain events, there will be certain stages where you know that in 1 year, bank is going to incur a loss. How will you pay for the customers' deposits then? I hope you understand. At that point of time, the bank has to use the capital. The money that is there in the bank has to use it to basically take care of the losses. That is the concept of a requirement of capital in a banking sector. Now, this capital that is there in the banking sector is divided into two types, core capital and supplementary capital. Slightly technical, follow this very, very carefully. Core capital and supplementary capital. Now, right, before you understand what is core, what is supplementary, let me give you a very simple example here. Two situations. Situation 1, situation 2. Two situations. In the first situation, imagine you are a bank. You will collect 100 rupees from me. I repeat, you will collect 100 rupees from me, but you will basically say there is no maturity period for this borrowing. What do you mean by this? I'll give a very simple example. Let's take this. Your friend has come back again, right? Let's take this. You will issue one instrument to me, right? You will issue one instrument. What is the value of the instrument? 100 rupee. And when you're issuing that instrument, you will tell me, sir, keep the instrument. Annually, I will give you 8% rate of interest, but there is no maturity period of it. There is no maturity period for it. I will repurchase the instrument, that is, let's say a bond. I will repurchase it whenever I want. Is the first example clear to you? Let me know. Is the first example clear? Argument is simple here. The bank is collecting the capital, money. Bank is collecting the capital. Bank is not giving any guarantee when they will return the capital to you. Second example, the bank is going to issue same 100 rupee bond, but only for 3 years. Right? Have a look at this. The bank is going to issue 100 rupee bond. I'll come to this. Don't worry. Right? The bank is going to issue a bond. Again, same 100 rupee worth, collect a capital of 100, but for 3 years. A simple question. Think of this and answer. On which of the 200 rupees? You have collected 100 rupee under situation 1. You have collected 100 rupee under situation 2. On which of the 200 rupees you will be more reliant? Reliant means I'm more dependent on this 100 rupee. Which of the 200 rupees? Situation 2. Interesting. Right? All of you answer. Participate. Right? I'll tell you which is correct, which is wrong. But participate. That's more important. Only then you will understand whether your thinking is correct or wrong. Your answer should be, sir, on situation 1, again, I told you you are a bank. I told you you are a bank. Think from a banker. Your dependence or your reliance on the 100 rupee of situation 1 should be more compared to situation 2. Now you will ask me why. Sir, as per my analysis, I'm a bank. I will be more reliant, I'll be more dependent on 100 rupee that I've collected under situation 2, but you're telling me exactly opposite. Why am I wrong? Answer is very simple. Imagine you have incurred a loss. Is it okay? Imagine you have incurred a loss. Incurred a loss means what? You have spent money, you have given a loan, you are unable to recollect it. Now, when you are unable to recollect it, from where will you get money to repay the depositor? Right? That is basically absorption of the loss. From where will you get the money to repay the depositor? If you repay this 100 rupee, after 3 years, you will have to give it back. I hope you understand. After 3 years, you will have to give it back. But if you look at this 100 rupee, is there any maturity period for this? Right? Is there any maturity period? No maturity period. You can simply say after 5 years, after 10 years, after 20 years, that is left to you. The bank will decide when they want to repurchase. I hope you understand. Which means this 100 rupee is there with you as long as you decide. This 100 rupee is there for only 3 years. On which 100 rupee your reliance should be more as a bank, it is this 100. Any difficulty in understanding it? Any difficulty in understanding this? Let me know. Right, so understand the logic here. The bank will collect capital from the market. They will issue different types of instruments. They will collect a lot of capital. But their reliance on the capital, which will be counted as a part of tier 1 capital, their reliance will be much, much higher. Is it okay? The bank's reliance will be much, much higher compared to their reliance on tier 2 capital. Sir, any example of tier 1 capital and tier 2 capital? This is where I want you to read current affairs. Now, simple question to you. In the last 1 month, do let me know, have you come across any news related to additional tier 1 bond or not? Let me see. If yes, what is the context? Tell me the context as well. My question is simple, by the way. In the last 1 month, let me check how many of you are reading newspapers. Have you come across any newspaper article related to additional tier 1 bond, AT1 bond or additional tier 1 bond? It was there in the newspaper. I'll tell you the context. Yes Bank. Yes Bank. Right? What is the context? I'll tell you. Just wait for the story here. Bombay High Court, right, basically has looked at the decision of the Yes Bank to cancel additional tier 1 bond and has said, no, you are not allowed to cancel the liability under additional tier 1 bond. But what is that concept? Why it was there? Why it is relevant for UPSC? Let's try and understand this. So tier 1 capital, one example, banks are allowed in India to issue additional tier 1 capital or additional tier 1 bond. What about the tier 2 capital? Banks in India are allowed to issue additional, the banks are allowed to issue tier 2 bonds as well in India. Now, what is the meaning of additional tier 1 bond? What is the meaning of tier 2 bond? Let me explain. Let's go step by step. Let me start with, right, basically the idea of secured and unsecured. There's a terminology called as secured and unsecured. Now, what is the meaning of secured and unsecured? Let's start. Imagine here is a bond. I'm issuing the bond to you. What is the value of the bond? 100 rupee. Now, some of you will ask me, sir, I will purchase the bond. I will give you 100 rupee. What should I do if you do not repay me 100? I hope you understand. Right? I'm issuing the bond to you. I am borrowing 100 rupees from you. You will ask me, sir, what should I do if you do not repay it? Then I'll simply say, here is my mobile phone. Here is my mobile phone. If I don't repay your loan, you can take away the mobile phone. Right? This concept is called as secured bond. Any difficulty in understanding it? This concept is called as secured lending or secured bond. For example, housing loans are secured. Any difficulty? Housing loans are secured. If you don't repay, the bank manager will come to your home, throw all of you out, right? Lock the home and put a very big notice and take away the keys. These are called as secured. Second, unsecured. Right? What do you mean by unsecured here? Simple. I will issue the bond to you. I will not provide any security. I will not provide any collateral, any security. Right? These are called as unsecured. Now, why this is relevant? Please remember this. Additional tier 1 bond and tier 2 bonds are unsecured. Is it okay? Additional tier 1 bond and tier 2 bonds, both of them are unsecured bonds. Point number 1. Point number 2. Let me start with additional tier 1 bond. These are the bonds which are issued by the banking sector. The capital, that is the money that is collected by the banks, will be counted as a part of tier 1 capital. Simple. It will be counted as a part of tier 1 capital. And under Basel, later you will see, under Basel, banks are supposed to meet a certain target of tier 1 capital. How much, etc., we'll have a look at it in some time. Don't worry about it. So the banks are going to issue these bonds, collect the money, count it as a part of tier 1 capital. Second, these bonds are unsecured. Third, these bonds do not have any maturity period. This is very important. These bonds do not have any maturity period. Right? Whereas in case of tier 2 bonds, when the bonds are issued, the bank says the bond will have a maturity period of, let's say, 5 years. The bond has a maturity period of 3 years, etc., like this. Right? In case of AT1 bond, there is no maturity period. The bank will repurchase it whenever it wants. Is the logic okay? Bank will repurchase it whenever it wants. Now, next important point. Both for additional tier 1 as well as tier 2. The bank which has taken the loan, is it okay? I'm using the term loan here because what is happening here? Bond is nothing but the concept of lending and borrowing. Right? I hope you understand. Bond is nothing but the concept of lending and borrowing itself. So understand the logic here. When the bank has taken this particular loan, and if the bank reaches a position where they cannot continue to operate if they repay the amount to you. I repeat, right? There's a technical term for this, PONV. I'll come to that. The bank has taken a loan by issuing the bonds, as simple as that. But if they repay this, they will not be able to continue to operate. In such situations, bank can simply decide not to pay interest to you, and bank can decide not to repay the amount to you. Is the logic okay? Right? I'll repeat it again. Just understand this carefully. I'm a bank. Right? Either additional tier 1 or tier 2. Don't worry. Look at this. I've issued a bond to you. I've borrowed money from you. I will have to repay the money. I will also have to pay interest to you. But if I come to a conclusion that if I pay interest, I'm going to incur such huge amount of a loss, I will not be able to operate. In such a situation, I can simply say, I will not pay interest to you. I can also say, I will not pay 100 rupees to you, which means your position as an investor, your position is as good as you have not invested money itself. Right? That is, you have invested, but the bank is not going to give it back to you. It's as if you have put the 100 rupee into Tirupati Hundi. That's it. You will not get it back. It's gone one side. So far, so good. Whenever the banks will decide not to return the 100 rupee, that is a principal amount, this is called as write-off. This is called as write-off. W-R-I-T-O-F-F. Write-off. Write-off means cancellation. Simply cancellation. And once the write-off is done, you will not get your money only. That is basically the concept of additional tier 1, right, as well as tier 2 bonds. And the statement that I used earlier, that is, if I reach a position where if I repay, I'm going to shut down, that situation is called as point of non-viability. Right? Have a look at this. That situation is referred to technically as point of non-viability, PONV. Now, understand this carefully. Additional tier 1 bond, you have given the money, bank has taken it, there is no maturity period. Don't you think it is very risky? Answer is yes. So rate of interest generally on such bonds is higher. Simple. Right? Rate of interest on such bonds is generally higher. And that is where investors in search of higher returns end up investing in these kind of bonds. Any issues so far? Any issues so far? Please do let me know, because I'll connect it to current affairs. I'll tell you a very nice story. I'll tell you a very nice story. Again, UPSC will not ask you the story, but it is there in the current affairs. You should understand it. Sir, what about tier 2 then? Simple. Bonds are issued by the bank, which are called as tier 2. Maturity period will be given to you, right? That is written in the bond. The bank will collect the money, keep it with itself, count it as part of the tier 2 capital under Basel, and after maturity period is over, the funds are returned back. That is the basic idea for tier 2 bonds. Now, what is the story I'm talking about? Listen to the story here. There is a bank called as Yes Bank. Couple of years ago, Yes Bank incurred huge amount of losses. Simple, step by step we'll go. Couple of years ago, Yes Bank incurred huge amount of losses. So when Yes Bank incurred, right, when Yes Bank incurred huge amount of losses, RBI being a regulator, right, removed the head of the Yes Bank, appointed one person who will take care of Yes Bank operations. Is it okay? They appointed a person who will take care of operations in the Yes Bank. Now, this new person looked at the fact that Yes Bank has issued a lot of additional tier 1 bonds. Yes Bank has issued lot of additional tier 1 bonds. The new, right, the person who was appointed by RBI, this particular person proposed a plan, restructuring resolution plan for the Yes Bank. And after the plan was proposed, Yes Bank came out and stated that whatever additional tier 1 bonds investors have invested in the Yes Bank additional tier 1 bonds, all of those 8,000 plus, in fact it was 8,400 plus crores, all these 8,400 crore worth of additional tier 1 bonds will be written off. Is it okay? All these 8,400 crore worth of additional tier 1 bonds will be written off. And the reason they gave was simple. As per the guidelines issued by RBI, if I reach a point of non-viability, I can write off the additional tier 1 bonds. That power is there with me. So that decision was announced by Yes Bank. Now investors looked at it and said, no, right? How can you write off? Right? No, we will not allow this to happen. They went to High Court. And very recently, Bombay High Court has ruled in the favor of investors and has asked Yes Bank that, or has directed Yes Bank that write-off will not be allowed. Now, some of you will ask me, sir, why? Why did Bombay High Court say write-off was not allowed by the Yes Bank? The reason the Bombay High Court gave this order was very simple. The Bombay High Court said a person has been appointed, an expert has been appointed by RBI. RBI did not tell the person to write off additional tier 1 bond. I hope you understand. RBI did not tell the person who was appointed to oversee Yes Bank to write off the additional tier 1 bond, which means the expert who was appointed has gone beyond the powers that were given to him by RBI. That's one. Second thing, the expert came out with a restructuring plan. But in none of the provisions in the restructuring plan, expert proposed writing off of the additional tier 1 bond. So so the Bombay High Court gave the order saying that this write-off decision of Yes Bank will not be held valid and the amount of money should be returned to the investors. Now you will ask me, sir, have they paid the amount back? Answer to that is no. Why? The Yes Bank as well as the Reserve Bank of India both have gone to Supreme Court of India, have appealed against the order issued by the Bombay High Court. Is the story okay with you? Is this story okay with all of you people? Right? This is a story. UPSC will not ask you to write this story. You don't have to be worried about the story. But was the concept of additional tier 1 bond, was it there in the current affairs? Answer is yes. Now, what about tier 2 bonds? Any example of tier 2 bonds? Yes. There is also one more story. There is a bank by the name of Lakshmi Vilas Bank, LVB, Lakshmi Vilas Bank. Right? This Lakshmi Vilas Bank issued tier 2 bonds and they also incurred a huge amount of loss. They also wrote off the tier 2 bonds that they have issued. Against that, many of the investors have gone to High Court. Now you will have to wait and see what the High Court will talk or let's say issue in the form of order or the judgment in the context of tier 2 bonds which were written off by LVB, Lakshmi Vilas Bank. Right, but anyways, argument is simple here. You don't worry about the judgments. Don't start reading about the judgments for economics. Argument is the banks will have to maintain capital, which is called as a tier 1 capital, more reliable for the bank compared to tier 2 capital. Any example of a tier 1 capital? Bonds which are issued by the banks called as additional tier 1 bonds are part of or an example of tier 1 capital. Any example of tier 2 capital? The banks have issued, many banks in India have issued tier 2 bonds, the capital under which is counted as a part of tier 2 capital under Basel. Right, so this is basically the concept of capital which is used or which is kept with each of the bank to absorb the losses that they are going to incur. Right, what has happened in the Supreme Court? My dear, they are yet to take it up. Right, do you think Supreme Court within 1 month will give a judgment? Just think of it, no? Right. RBI has money, then why bother about repay to Yes Bank 81 holder because may lead to lose confidence in the investor? My dear, no. That's the reason. Please understand this carefully. RBI has money doesn't mean that if a bank incurs loss, the depositors will get the money or the investors will get money from RBI. No, in that case, RBI will go bankrupt very soon. RBI will not give that money. You are simply thinking of something else. RBI will never give that money. Right? Why should RBI give? You tell me, why should RBI give? Does RBI own Yes Bank? Just think of it, no? Does RBI own Yes Bank? Yes Bank is a private sector bank, by the way. It's not even public sector bank. Right? So why should RBI pay that money? Right? What is your logical reason in that? Please do let me know. But anyways, RBI will never do that. Okay, next, concept of risk associated with the banks. Okay, concept of risk associated with the banks. Let me ask a very simple question. Imagine you're a bank. You will give me a loan of 100 rupee. That I have only 100 rupee, don't worry. So you are a bank, you will give the loan of 100 rupee to me. What if I don't repay the loan to you? Are you facing a risk or not? Let me know. Right, I'll repeat it again. You are a bank, you will give a loan of 100 rupees to me. If I don't repay the loan, are you facing a risk or not? And can that risk basically convert into losses? Can that just translate into losses? Answer is yes, by the way. Answer is definitely yes, by the way. That risk where the lenders will face, right? Understand this. The risk that the lenders or the creditors face, it is called as credit risk. That is, the borrower, if they do not make the repayment, that risk is referred to as credit risk. Now, two things here. One student is asking, but there is a DICGC, Deposit Insurance Credit Guarantee Corporation, in the context of additional tier 1 bonds. Why is that not paying it? You tell me. I'll ask you a very simple question. If a bank issues a bond, collects money, is it equal to deposit? Just think of it and answer. Right? You are asking me, you are asking me a question. Sir, there is an authority called as DICGC. Shouldn't the DICGC pay back the amount on bonds? Do you think the borrowings are done through bonds is equal to deposits? Answer is wrong. No, they are not equal to deposits. Right? These are different investors. These are different investors. Right? Second, there is also a question. Okay, there is also a question. Which bond has maturity in AT1 bond and tier 2 bond? Again, I'll repeat it. It is there in the slide itself. Additional tier 1 bonds, there is no maturity fixed. Bank will recall them. Recall them means bank will repurchase them when they want to. In tier 2 bonds, no, when they are issuing, they will tell you what is the maturity period. Okay. Why tier 2 bonds are unsecured? It's not just tier 2, even additional tier 1 bonds are unsecured. These are generally unsecured in the market, carry very, very high risk. And please understand this. Some of you will ask me, in that case, sir, why will the investors invest? You tell me. Right? Don't you think there are investors for both the types of bonds? Why do you think they are investing? If they are not getting any collateral, you tell me, why are they investing? Because they want to earn higher returns. That's it. Very simple. They want to earn higher returns. Right? Generally, students keep on asking these kind of questions. You know the answer already. Right? For example, I'll ask you a very simple question. Another question. There are cooperative banks in India. Right? I hope you know there are cooperative banks. There is also SBI. Now, despite having SBI, why do people keep deposits in cooperative banks? I hope you understand. Right? Despite having SBI, Canara Bank, Bank of Baroda, right? Don't you think there are multiple types of these types of banks? But even then, why do people keep money in the cooperative banks? Because the rate of interest offered by cooperative banks is slightly higher. Simple. Right? So that they will run to cooperative bank, they want to earn higher rate of interest, they will keep the money there. That's a reason. Okay, now come back to this. Three types of risk faced by the bank. One is called as a credit risk. You will give a loan. What if the borrower doesn't repay? Is it risky for you? Yes, it is risky. What that is called as credit risk. Second, market risk. Right? Have a look at this. The market prices can cause losses for you. The market prices can add to your losses. How? Imagine you have purchased gold, right? I hope you understand this. SLR, statutory liquidity ratio, SLR. You have invested part of your deposit in gold. Now, what if the market prices of the gold falls down? I hope you understand. Market prices of the gold falls down. Now, some of you will say, sir, I will not purchase gold only then. You will purchase a government security. Do you think the price of the government security always remains the same? Right, from morning we have been discussing this. The price of the government security will always remain same. No. When you purchased, the price of the government security was, let's say, 95 rupees. And when you're selling, it could be 97 also, it could be 92 also. There's no guarantee. But what if when you're selling, actually the price is 92? Don't you think you purchased it at 95, you sold it at 92? You have incurred a loss of 3 rupees there, right? So understand the logic here. There is variation in the market. A lot of fluctuations happen in the market. As a result of this, you might incur losses. Third one, operational risk, right? The issue of operational risk, right? Operational risk simply refers to losses which are arising out of, or losses which are resulting from inadequate or failed internal processes, people and systems, or from external events. Let me give a very simple example. You gave a loan, right? Or let's say you have set up an ATM machine, right? Somebody has stolen the ATM machine. You tell me, don't you think the amount that was kept in the ATM machine is a loss for you? I hope you understand, right? If you disagree, please do let me know what is the reason you are disagreeing. Right? Imagine you're a cashier. You collected the amount. But one of the currency note is a fake currency note. Is that not a loss for a bank? Right? Data theft will happen. Right? Somebody might simply transfer funds without your authorization. Authorization simply means somebody has hacked your account. From the account, that is a bank account, funds have been transferred. Is it a loss or a not? The cashier has counted money given to you, right? They have basically counted the money and given to you, but in the process of counting money, they have given one extra currency note. Is that a loss or not for the bank? So understand this. There are many such events. There are many such instances where the banks will actually incur losses. Such types of risk is referred to as operational risk. Is it okay? Operational risk. So banks will face credit risk, bank will face market risk, and the bank will always face operational risk. Now I can see some of you are trying to find out loophole in everything. So this can happen, that can happen, but you are wrong, etc. Let me give a very simple example. I told you, you give a loan, the borrower doesn't repay, right? Then you will face a credit risk. Then a couple of the students said, but sir, you are wrong there. You would have taken a collateral. Right? Let's assume you are right. You have taken a collateral. Let's apply it in real life. State Bank of India has given thousands of crores of loans to Sri Vijay Mallya ji. How many of you think they have recollected all the 2000 crore rupee loan? Just read the newspapers, you will understand all of it. How many of you think that the State Bank of India has been able to recollect every penny, every rupee of loan that they have given to, right, the borrower such as, right, Mr. Vijay Mallya? If you think that they have been able to recollect, you are living in a different world altogether. The answer is no. They have not been able to recollect. Then what happened to your theory of collateral? What happened to your theory of security? Don't you think there was a security? Aeroplanes? Yes, it was there. Don't you think offices of or office space of Kingfisher company were kept as collateral. Yes, it was kept as a collateral. What you're missing is there is a variation in the market prices of assets. I'll tell you, right? The fact that you are not accounting for variation in the market prices of the assets will make it very difficult for you to recover all of these. Right, sir? What do you mean by that? Kingfisher owned aeroplanes. The company did not repay the loan. The bank took basically all the aeroplanes, tried to sell it off. Now, will you be able to recover the full amount of money even after selling all the aeroplanes? Right? Answer is simply no. So, argument is C. The bank will face this risk. That's a fact. Bank might incur losses because of all the risk. One of them, two of them, or all the three of them. That's also fact. Done? So, the banks will face credit risk, market risk, and operational risk. Now, have a look at this. In order to address this, that you know there is a risk, you might incur losses. In order to address this, there is one more concept that was introduced under Basel, RWA, risk-weighted assets. RWA, risk-weighted assets. Now, what do you mean by risk-weighted assets? Before I explain to you, I've given the table. Please do not by heart this table. UPSC is not going to ask the table. Please do not by heart it. In fact, if you have read any of the books related to Basel, any book, right, GS paper 3 by the way, where Basel is discussed, they don't discuss all of it. They'll simply give the guidelines and go ahead. Now have a look at this. Before I go forward and explain to you what is the idea of a risk-weighted asset. First point, loans are the assets of the bank. Any doubt in this? The bonds, right, bonds which are issued basically, right, let's say the borrowings, right, are there for a bank. The loans are issued by the bank. Loans are assets of the bank. Anybody has an issue with this? Please do let me know. Point number one. Right. Second, understand this carefully. All the loans do not carry same amount of a risk. Agreed? If you disagree, please do let me know. All the loans do not carry same amount of a risk. Meaning what? Imagine you are the bank. One loan you have given it to government. Another loan you have given it to me. Do you think both of the loans are risky for you? Or let me rephrase it in a better way. Both of the loans, do you think they will carry same amount of risk? Answer is no, by the way. Right? Answer is no. If you have given a loan to the government, the risk is not there. In fact, under Basel, most of the times they will write a 0% risk there. Why? Government has taken the loan. Government always will repay the loan. I hope you understand. Talk about India for that matter. Right? It's been more than 70 years. You tell me any year where government of India has taken the loan and has not repaid the loan. I hope you understand. So basically argument is this. You give loan to different borrowers in the market. All the loans will not carry same amount of risk. For that, under Basel, there is a concept called as risk-weighted assets. Right? Understand this. There is an idea called as risk-weighted assets. Right? Because of operational risk, because of the market risk, because of the credit risk, how much of the total loans might lead to losses for me? I hope you understand this. I want to find out, because of the market, operational or credit risk, out of the total assets, how much could be my losses? That is called as risk-weighted or assets or risk weighting of assets. How does a bank do it? I will show you a simple calculation. Do not by heart it. Please don't worry, UPSC is not going to ask this. Imagine a bank has given 3 loans. They have given 3 loans, 50,000, 30,000 and 20,000 respectively. What is the total assets of the bank? Total assets of the bank is 1 lakh rupees. And one of the loans they have given it to, let's say, government. So because they have given it to government, are they facing any risk there? They are not facing any risk. Guaranteed, they will get the they will get the 50,000 rupees back. So risk weightage is 0. How much of the asset is risk weighted? 0 rupees. Second, let's say they have given a loan to a businessman and they assume that, and all of this is given under Basel only. As per the Basel, this loan should be given a weightage of 50%. So out of 30,000 rupees, if 50,000 of the 50% of the asset is risky, can I basically calculate it and say 50,000 rupees is risky here? And third, imagine they have given one more loan where the risk weightage is 80%. So 16,000 rupees, because 80% of 20,000, 16,000 rupees is risky. Now look at this. Total value of the asset is 1 lakh rupees. Out of this, 31,000 rupees is risk weighted assets, which means up to 30,000 rupees I might incur losses. I might be incurring certain amount of losses right up to this amount. Please understand this. Exactly 31,000, will it be a loss? Absolutely no. It is just an estimate. As per the parameters that are given, up to 31,000 are risky for me. I might incur losses up to this amount. That is the basic idea. Right? So now what should you do? You know the assets are risky because of credit risk, because of operational risk, because of the market risk. You might incur losses. Then under Basel it says you will have to hold a certain amount of capital so that if you incur losses, you can use the capital to absorb losses. Is the logic okay? Right? What do you mean by absorption of losses? I'll just give a very, very simple example. Technically, it doesn't happen like this. You don't write it. But let me give a very simple example. Right? Imagine I've issued an additional tier 1 bond. I've collected 100 rupees. Is it capital? All of you agree? Is it capital? Yes, it is capital. Now on the other hand, imagine I've taken I've taken a deposit of 100 rupees from you. I've given it as a loan to a businessman. The businessman doesn't repay the loan. They don't repay the loan. Is it okay if I say I'm going to incur losses because of this? Let me know. Start participating. We'll take a break. Don't worry. Another 20 minutes. We'll take a break. Don't worry. Start participating. So step 1, I've issued a bond. I've collected 100 rupees. Let's say additional tier 1 bond. Step 2, I've taken 100 rupee deposit from you. Don't worry about CR or SLR. Don't worry. I've taken 100 rupee deposit from you and I've given it as a loan to a businessman. Step 3, the businessman incurs a loss, doesn't repay anything out of 100 rupee. Now tell me, from where do I get the money to absorb the losses? Additional tier 1 capital? All of you will agree? Additional tier 1 capital. Because argument is simple here. If I repay this additional tier 1 capital, do you think the bank can continue operating? Just think of it. Just this example. Keep it very, very simple. Keep it very, very simple. If the bank will give back 100 rupee to the additional tier 1 bond investor, do you think the bank can continue operating? How? How do you think the bank can continue operating? You will come to withdraw 100 rupees. I don't have money. I've incurred losses. I've given back the 100 rupee to the investor. Where do I have the money to absorb the losses now? That is the precise reason Basel guidelines say maintain capital. Have certain amount of capital which you can use to absorb the losses. Is the logic okay with you? Right? And the minimum amount of capital that you're supposed to maintain is called as capital adequacy ratio. Look at the name for this. The minimum amount of capital that you're supposed to maintain is capital adequacy ratio. Because right? I hope you understand the problem. You are a bank. Think of this. You are a bank. How much additional tier 1 bond should you issue and collect? Is there any idea? How can you find out? I hope you understand the process here. You're a bank. Right now, simple question to you people is, how much tier 2 capital should you collect? How much tier 1 capital should you collect? How will you come to know? And how will you understand how much capital should I maintain? For that, we need to first assess how much of our assets are risky. Then there is a concept called as capital adequacy ratio. Now follow this carefully. Capital adequacy ratio, another name for this is CRAR, capital to risk weighted assets ratio. What is the meaning of it? It simply represents the minimum amount of a capital each of the banks should maintain to absorb the expected losses. Is it okay? I'll repeat it again. Right? What is the idea? The capital adequacy ratio simply means how much minimum capital each of the banks should maintain in order to absorb the losses. Look at the other definition for this. In simple terms, it represents the ability of the bank in meeting the needs of the creditors and depositors. Meaning what? You have given the loan, right? You have given the loan, you have taken the deposits from the customers. Now, how much minimum capital you should have to ensure that whatever losses you are going to incur, you will be able to absorb the losses. That is called as capital adequacy ratio or capital to risk weighted assets ratio, CRAR or CAR. What is the formula? Total capital divided by risk weighted assets. I repeat, total capital of a bank divided by RWA, risk weighted assets, into 100. Let me give a very simple concept here. If the capital adequacy ratio is 9%, right, for most of the banks it is 9% in India. If the capital adequacy ratio is 9%, what does it mean? It simply means your risk weighted assets are, let's say, 100 rupees, then you're supposed to maintain a capital of 9 rupees. Is it okay? I'll repeat it again. If your capital adequacy ratio requirement is 9%, what does it mean? It simply means that if your risk weighted assets are 100 rupees, then you should maintain a capital of at least 9 rupees. Now, is it okay if I say, follow this carefully, is it okay if I say, if a capital adequacy ratio of a bank declines, the risk associated with the bank will increase? Let's say, right, I'll repeat the statement, right, I'll repeat the statement. If the capital adequacy ratio of a bank decreases, it means that the risk associated with the bank is increasing. Correct or wrong? Right? Nobody wants to answer it. Right? Nobody wants to answer it. Is it correct or wrong? Is the statement correct or wrong? The statement is correct, by the way. Statement is correct. Right? Some of you are saying wrong. Please re-evaluate. Re-evaluate. If the capital adequacy ratio of a bank is decreasing, you tell me why the capital adequacy ratio of a bank is decreasing. Let's say your capital doesn't change, but your denominator changes. Risk weighted assets are increasing in a bank. Do you think that is a safety for a bank? It is going to increase the safety for a bank? No, it is going to increase the risk for a bank. That is exactly what I'm saying. I hope you understand this. Right? If capital adequacy ratio of a bank decreases, what does it mean? The risk assets in a bank are going to increase. Is it good for a bank? No, it is not good. It is more risky for a bank. Right? That is the reason capital adequacy ratio should increase, not decrease. If CAR increases, safety for a bank increases. It represents a bank has more and more capital to absorb losses. If CAR decreases, bank doesn't have sufficient capital to absorb the losses. That is a basic idea. Okay. Now, same calculation I've shown, right? Have a look at it, right? I've shown the calculation. Please go through this. Please do not by heart it. This is my sincere recommendation. Please do not by heart it. Okay. Now, can I go to the next one? Can I go to the next one? To understand Basel guidelines, you are supposed to understand all these concepts. Right? Some of you might be thinking, sir, for last 40 to 45 minutes, you have told us so many concepts. What is the reason? Simple. To understand Basel, you should understand these. Right? Now have a look at it. Basel guidelines, 3 rounds of Basel guidelines have been issued. So far, 3 rounds. Basel 1, right, back in 1988, Basel 2 and Basel 3. Right now, we are in the process of implementing Basel 3 guidelines. Right, in India, we are in the process of implementing Basel 3 guidelines. That is point number 1. Point number 2, I will ask you a question, answer it. Who is responsible for implementation of Basel guidelines in India? Which authority will be basically, right, be regulating whether the right banks are implementing the Basel guidelines or not? RBI. All of you will agree? Reserve Bank of India. Right? RBI is the authority which will ask all the banks in India to implement Basel guidelines. Why? RBI is the regulator. That's the reason. Now come to the first one. Basel 1 guidelines announced in 1988. Under Basel 1 guidelines, they identified one risk faced by the bank, credit risk. And they also recommended that banks might incur losses because there is a risk. So the banks must calculate what is the risk weighted assets. And because there could be losses incurred, banks must maintain capital adequacy ratio of 9%. Banks must maintain capital adequacy ratio of 9%. Right? Now again 8%. Now before I go forward, here is an important point. I have written 8% here. You will read somewhere it is 9%. Neither am I wrong nor are they wrong. Before going forward, here is an important point. I have written 8% here. Somewhere you will read 9%. They are also not wrong. I am also not wrong. Now some of you will say, sir, how is that possible? Right? Our high school teacher has taught that 8 and 9 are different. You are writing 8 and you are saying 9 is also correct, 8 is also correct. Which one is correct? Basel committee recommended 8%, but the banks, that is the regulators, were given the freedom to change it. Right? I hope you understand this. Basel committee recommended 8%. The regulators, that is the banks, central banks, have been given the freedom to change it. So what Reserve Bank of India has stated is, I will not keep it at 8%, rather I will increase it to 9%. Is it okay? I will not keep it at 8%. I will change it. In fact, in case of India, it is not 9% for all the banks. For some of the banks, it is 9%. For some of the banks, it is 12%. For some of the banks, it is 15%. Right? So understand this carefully. If the books say Basel committee recommended 8%, correct. If they say India is implementing 9%, it's correct. Right? Because the freedom has been there, RBI has changed it. Has India adopted Basel guidelines 1? Yes, India has already implemented Basel 1 by 1999. Second, Basel 2. Right, Basel 2 norms or Basel 2 guidelines. This was announced by the Basel committee back in the year 2004. India has implemented Basel 2 guidelines. Under Basel 2, please understand, they followed a 3-pillar method. Understand this. They followed a 3-pillar approach. They will use this kind of a statement. Don't be confused. Basel 2 follows a 3-pillar approach. What do you mean by three pillar approach? Three parameters are there. One is, three risks are there. To address these three risks, three parameters are followed. What are the three risks? Credit risk, market risk, and operational risk. Did we discuss earlier what are the three types of risk? I hope you understand. Earlier itself we have discussed all the three. So because there are three risks, in order to overcome all the three risks, a three pillar approach has been recommended. What are the three pillars? Capital adequacy ratio, this is pillar 1. Supervisory review, this is pillar 2. And market discipline, this is pillar 3. Three pillar approach. First one, capital adequacy ratio, CAR. Every bank must maintain certain minimum amount of capital which they will use to absorb losses. Capital adequacy ratio. I've written it. In India it is 9% for some of them, 12% for some of them, and 15% for some of them. Who will decide it? Reserve Bank of India. RBI decides it. Then there is a supervisory review. Now what do you mean by supervisory review? Follow this concept side carefully, slightly technical, follow it. Imagine you're operating a bank. You know that you are facing credit, market, and operational risk. Is it okay? You're operating a bank, you are owning a bank. Now you know that you're going to face credit risk, you're going to face operational risk, and you're going to face even the market risk. A simple question to you: will you implement any policy in order to reduce the risk or not? Start answering. Last 2 points we'll discuss, then we'll take a break. Start answering. You are owner of a bank. You know that you are facing three types of risk: credit, market, and operational. Will you not implement any tool? Will you not introduce any system, any policy to minimize all the three types of risk? Answer is yes, by the way. If you say no, please don't enter into banking. You will incur losses very, very soon. Right? You know you are facing a risk. Will you not take any step to reduce the risk? Will you not implement any policy to reduce the risk? Answer is yes. So the policies, the steps, or the measures which are taken by the bank to reduce the three types of risk, that is called as supervisory review. Have a look at this. Banks need to develop better risk management techniques to monitor and manage all the three types of risks. And finally, some of you will be concerned, sir, how does RBI know what a bank is doing? Many of you have this doubt, right? You said we are supposed to maintain a capital adequacy ratio. How does RBI come to know? Reason is the third pillar, market discipline. Under market discipline, whatever you are doing now, for example, how much tier 1 capital you have raised, you will have to inform RBI. Right? How much is additional tier 1 bond? Inform RBI. What is your capital adequacy ratio? Inform RBI. So you'll have to keep, right, disclosing all of this information to the regulator of the banking sector, that is RBI. That is market discipline. So this is a three-pillar approach. This is called as a three-pillar approach. India is following the Basel II guidelines. Now there is a third one, Basel III, which I'll take up after the break. Let's take a break now. But before that, right, if you have any questions, please raise it. I'll address, then we'll take a break. So please tell if there is any other system to control inflation other than increasing repo rate, CRR, etc. My dear, did you attend inflation lecture or not? Have you attended the lecture on inflation? Did we not discuss how India, or how does right government, how does RBI, etc., through their policies will help in controlling inflation? We have discussed it already, right? All of that is over. If capital adequacy ratio is 9%, what does it mean? It simply means if you're facing or if you're having a risk weighted assets of 100 rupees, you will have to maintain a minimum capital of 9 rupees. That's it. To maintain car, how they manage expense? What expense are you talking about? What expense are you talking about? Right? To maintain car means what? They are issuing bonds, they are issuing shares, etc. They are collecting capital and keeping it with themselves. That is called as maintaining the capital adequacy ratio. Okay, any other questions? If ATM theft happens, is there any insurance? Generally, banks have a lot of insurances, right? For deposits also they have insurance, many other insurances they have. What is core capital and supplementary capital? I'll repeat it again. Core capital is another name for tier 1 capital. I hope you understand this. Core capital is another name for tier 1 capital. Supplementary capital is another name for tier 2 capital. If they use the term core capital, simply understand they are talking about tier 1 capital. And what is a tier 1 capital? It's that amount of money or asset that the bank has on which reliance of the bank is very high, which can absorb the losses very, very easily. That is tier 1 capital. Okay. Why capital is maintained? My dear, it simply means you have joined now. After all of this, capital adequacy ratio, etc., you are asking me why capital should be maintained. Then basically you have joined now. It simply means that the banks should maintain capital to absorb losses. For CAR, capital adequacy ratio, should the bank pay interest rate? How? You tell me. For capital adequacy ratio, it is a capital that the banks have collected. How do they pay interest rate? If it is a bond, they'll pay interest rate. If it is a share, right, there is no interest rate for a share. Okay. Done. Okay, let's take a break now. Tier capital must be returned by the banks, or can banks still cannot give back like tier 1? Tier 1, additional tier 1 bonds can be written off. Tier 2 bonds can be written off. Shares are there. There is no concept of returning the amount in the share. We'll discuss that later. Shares, generally, there is no maturity period. These are perpetual in nature. Okay. Done. Okay, let's take a break now. Time is 5:02. I'll restart at 5:32. I'll start the discussion again at 5:32. Okay, join back at 5:32. I'll restart it again.